Hello, this is CRP talking to you all. How you doing? Let me just check to make sure that everybody can hear me properly. If you can hear me properly, be so kind as to raise your little hand just to make sure that everybody is on board. Great, terrific. I see lots of little hands. So that means that everybody is more or less listening to me properly. Thank goodness. Now, before I get into this webinar, I just want to make it really, really clear that I am not a financial advisor. I am not giving any kind of financial advice. In some jurisdictions, as a matter of fact, it would be illegal for me to do so. This is just a primer to talk about how to trade and how to invest. This is geared towards people who might be newbies to those who are moderately advanced. This is something so that you understand how to get into it, because a lot of people have been asking me about, how to trade, how to invest, what's this, that, the other. And so, I figure I'm going to do this webinar to talk about this stuff. But I have to emphasize, none of this is investment advice. And if I ever mention any stock or bond or anything of the sort, it's strictly as an example. Okay, I just want you all to be really, really clear about that, because I don't want anybody to be suing me later. Okay, I don't want to be sued, and I don't want the cops to, pick me up for pretending to be some sort of financial advisor when I am not pretending to be a financial advisor at all. I am simply going to tell you how it is, how it works. But you will have to do your own due diligence about any kind of investment that you seek. Okay. Okay, this is just me explaining the rules of the game, but each of you has to play on your own. Okay? Okay, so let's get started. So the first thing that, as usual, here is the outline for today's broadcast. I hope it's not too small for your screens, because I know that some of you watch it on phones. Sorry about that, it couldn't be helped, but I wanted to get everything on a single screen so that you can all see it properly. And sorry, last time I'll ask this, just a quick sound check. Everybody hearing me okay? Is the broadcast all right? Raise your hand if it is. If the broadcast is all right and you can hear it properly and I'm not too low or anything of the sort. Yeah, okay, great. That's great to know. Okay, so let's get started. The first thing that you have to understand before we get into the whole notion of what is trading and what is investing is to understand the difference between the two. A lot of people don't understand the difference. It is essential to understand the difference between trading and investing, because that way you understand what you are doing. A lot of people say, oh, I traded this, oh, I'm investing in that. But that's two different things. To purchase an asset, whatsoever that asset may be, whether it be commodities, stocks, bonds, or real estate. To purchase it, you have to be thinking before you purchase it whether you are trading it or whether you are investing in it. The difference between trading and investing is that when you trade in something, you are looking to make money off the price differential. For instance, I buy a stock XYZ this morning at 100. And by the afternoon, it's at 150, and I sell it at 150. That's a trade. I purchased it at 100, and I purchased it, why? Because I'd heard that they were going to come up with some new drug or invention or whatever that was going to make a stock XYZ shoot the moon. And indeed it did. I bought it at 100 in the morning, and by afternoon, it's 150. That's a 50% return on investment in 8 hours. That's terrific, right? We would wish all our trades were that good, but that's a trade. I went into it knowing that I was going to sell it later. An investment is, for instance, I've heard that this piece of land here that is worth $100,000, it produces an income stream. Because say, let me rephrase this. I buy an apartment, and this apartment costs $100,000, and I can rent out the apartment at $1,000 a month. $1,000 by 12, because there are 12 months to a year. That's $12,000 per year of income over a price of $100,000. That's 12% return on investment. And you see, that's an investment, because what I'm buying there is an income stream. I'm not thinking that I'm going to buy the apartment today and sell it tomorrow or next year or whenever for a higher price. No, I'm buying it because I don't really care about the price. I care about how much is going to be a return on investment. You see the difference? It's very important that you always understand this difference between trading and investing. And you will then realize that there are certain asset classes that can never be invested in. You only trade in them. For instance, agricultural commodities like wheat and soybeans and whatnot. You don't invest in them because there's no money to be had in soybeans or wheat. No, you buy it at one price and sell it at another and hope that there's a difference in price that's positive. There's no way to invest in it. Whereas other asset classes, you specifically buy them in order to invest in them. Although as of late, I'm talking the last 20, 30 odd years or so, there has been that hasn't been working out because of things that I'll explain later. But I want you to understand at the very beginning, the notion of what is trading and what is investing. When you invest in something, it's not that you are holding it on deliberately for the long run. No, you are buying it because it produces an income stream. That's why you're buying that asset. Whereas in the trade, you don't really care about the income that the asset produces while you hold it. You only care about the price difference when you sell it. That's the difference between investing and trading. You always want to have it at the forefront of your mind whenever you go into any asset class. Because see, when you go into an asset class, whatsoever that asset class may be, you buy it, of course. But the reason, the motivation behind that purchase, you have to be aware of it because that will tell you whether you are trading in it or investing in it. And when you trade or invest, there are radically different approaches that you take. Now, let me get into it. Okay, the whole notion hinges on yield. Okay, yield is the metric by which a trade or an investment is successful. What is a yield? It's the percentage that you earn by getting into any asset class. Okay, like I will explain them in just a moment, and you see there on your screen, there are essentially 5 asset classes. There are commodities, stocks, bonds, excuse me, 4. Commodities, stocks, bonds, and real estate. I missaw there, sorry. Commodities, stocks, and bonds and real estate. Those are the asset classes. Now, when you get into them, whatsoever that asset class may be, and by the time you get out of it or a year's time has passed, you want to know what the yield is. Now, what the yield is all the money that you earn from owning that asset class. Let me give you an example. XYZ stock before, right? I bought it this morning at 100 and I sold it this afternoon for 150. The difference between those two prices is $50. 50 divided by 100 is 0.5. That is 50%. The yield on that trade was 50%. By the way, it would be useful for you guys to break out some paper and a pencil so that you can follow along in this. Okay. Let me do a different example that emphasizes the same point. I buy stock ABC. I buy it at 100. But then bad news emerges and they say that the stock is going down the tubes. And so I sell it this afternoon at 90. It went down 10 in just the course of the day. But I sold it at 90 because I thought to myself, you know, the news is really bad. It'll continue to go down. So I'm going to sell it now because maybe tomorrow it'll be even lower. So better cut my losses now while I still can. You see the motivation? You see the thinking behind it? So ABC stock, I bought it at 100 this morning. Bad news, it has like, I don't know, it missed its earnings, or maybe there's a big lawsuit or antitrust lawsuit by the government, or who knows what happens. It doesn't matter. The CEO had a heart attack, whatever bad news, but it went down in price to 90. So I sold it at 90. What's the price differential? Negative 10. Yeah, of course, because the price that I sold it was 90, but I had purchased it at 100. 90 minus 100 is negative 10. Negative 10 divided by the original price, which was 100, that's negative 0.1, or expressed differently, negative 10%, correct? So what was the yield on this particular trade on the ABC stock? It was negative 10%. I lost money on that trade. You see? Now, of course, what you want is for your yields to always be positive. That's the point of it. Let me give you a different example. I purchased an apartment for $100,000. I purchased it on the 1st of January. and I rent it out for $1,000 a month. But like say that there are certain expenses, say maintenance, and there's property tax. During the year, I receive $1,000 every month. That is $12,000 by the 31st of December, right? But from that $12,000, I have to discount the expenses that I had to pay to own this particular asset, that is this apartment. I have to pay property tax, I have to pay, I don't know, just upkeep, I had to repair something, get a new AC, whatever the expenses were that I had to pay, because there are certain expenses that I pay as the landlord, and there are certain expenses that the owner pays as, the renter pays as the tenant, right? For instance, the tenant pays electricity and water and internet and cable. But I have to pay, for instance, if the toilet breaks, because that's just a natural use on the part of the tenant, assuming, of course, the tenant is not, breaking it on purpose, right? So anyway, I add up all the expenses I have for that property, and I, of course, ignore the expenses that the tenant paid because that's his problem. I had to pay property tax, I had to pay upkeep, and let's just say, just to keep the math simple, that for the year I had to pay $1,500 in various expenses and taxes. I'm just making hypothetical here. So I earned $12,000 in a year of rental income, but $12,000 I have to discount from that $1,500, which were the yearly expenses, property taxes, and the broken toilet and whatnot. So 12,000 minus 1,500 is 10,500. That was my net income. What was my yield for this property? Well, I purchased it for $100,000. I earned, after all expenses, $10,500. So $10,500 divided by $100,000 is what? Positive 0.105. That's the division of 10,500 divided by 100,000. Expressed a different way, this 0.105 can be expressed as percentage, which would make it 10.5%. That was the yield of the property. And we can expect the yield to continue into the future because, rental prices, let's just say for the sake of argument that they're stable and expenses are stable. So you can say that this property that I bought for 100,000, its yield is 10.5% per year. You see? You see the difference of how you would express the yield on a trade and the yield on an investment? You express yield on a yearly basis. It's all the money that you accrue from the investment during the year minus the expenses divided by the original price of the asset that you purchased. Notice, it's the price that you paid. It's not the market price today. That does not matter. And this is crucial. A lot of people don't understand this many times, and they screw up because a lot of times they think that the yield on the asset depends on the current market value of that asset. It doesn't. It depends on when you purchased it, or the specific owner of it, or the price that you are getting that asset offered, if it's on offer and you can potentially buy it. It's not the price today. It's the price that the investor paid for it. I purchased this apartment for $100,000. Perhaps, just for the sake of argument, it goes up. It goes up in value to $150,000. And you could say, well, then if I earned $10,500 from this asset class, then the yield would not be 10,500 divided by 100,000. It would rather be 10,500 divided by the current price, which is $150,000, and that would be 0.07, i.e. 7%. That's the return on the investment, right? Wrong, wrong. You always express the yield by the price at which you purchased it. You see? That's really, really important. And it'll matter later. Just keep it in your mind, okay? Anyway, going back to the issue of yield insofar as trades are concerned. A lot of day traders, a lot of people who just spend all their days buying and selling whatever asset class, be it agricultural commodities, precious metals, industrial stocks, bonds, whatever it is that they're buying, they often think in terms of their yield on a specific trade, but they're also thinking of their overall yield throughout a period of time, usually a year. And the way they calculate that is very simple. They start with how much money they had at the beginning of their trading period and how much money they had at the end. They look at the price differential and they divide that price differential by the original amount. Say for the sake of argument, I've talked to you about these two stocks, stocks ABC and stocks XYZ. XYZ was a bumper, bumper crop rather. I bought it at 100 this morning and sold it for 150, so I got 50% return on investment. The other one was, it was a loser. I bought it for 100 and went down to 90 and I sold it at a loss, right? Now, these two trades, hypothetically, let's just suppose that I invested $100 in both of these stocks, 100 on ABC and 100 on XYZ. And at the end of the day, I sold both, one for a loss of 10 and the other for a gain of 50. I add up that loss and that gain. Negative 10 plus 50 is 40, of course, right? And I started with $200 because I invested $100 in ABC and $100 in XYZ. So what was the yield for the day? It was negative 10 plus positive 50, which is 40, divided by 100 plus 100, i.e. 40 divided by 200. 40 divided by 200 is what? 0.2%, 0.2. That is 20%. That's what I earned. I earned 20% on my two trades in that day. Now, of course, you can stretch this out insofar as time is concerned. Suppose, for the sake of argument, that you did the exact same trades, but instead of just a day's time, you did it over a month or a year, okay? That's how you would figure out your yield for a year. Of course, you'd have, if you're day trading, you're probably buying and selling multiple stocks during the day. It doesn't matter. Some people do dozens of positions in a day. Some only do one position in a day. Some are very slow traders and they buy something on a Monday and wait around until, I don't know, Thursday or Friday to sell it because that's their investment strategy, their trading strategy rather, their trading strategy. But each trader that is a person who buys and sells and tries to make it money by way of the price difference, right? They have their own trading strategy and that's fine. But in the end, everybody measures their yield the same way. During the period, they add up all their losses plus all of their gains and divide that number by the original money that they started out with. And that's their yield. And usually, a trader will look at his trades during a year's time. Sometimes for various reasons, you'll want to see it every quarter or even every month or even every day or week, okay? But for various reasons that are not pertinent to this primer, I just want you to understand the notion of yield. For investments, you always measure a yield on a yearly basis. For trades, you have to define the period for which you're measuring the yield. You see? Because sometimes it'll be, a day's yield, and sometimes it'll be a week or a month or a quarter or a year. Understand that difference. And at the end of the day, the yield tells you if the person is successful as a trader or as an investor. If their yield is positive, they're successful. If their yield is over 10% per year, they're a god. Simple as that, okay? And for various reasons that I will get into in a bit, getting over 10% yields per year is exceptionally difficult and has been for quite a while, unless you are trading, which is anathema to me, but I'm getting ahead of myself. I just want you to understand the concept of yield. That's very important. Okay, so there are asset classes. Now, what do I mean by asset classes? There are different assets that you can buy, either to trade or to invest. These asset classes can be summarized into 4 categories: commodities, stocks, bonds, real estate. Now, what are each of these? Commodities are foodstuffs, they are industrial metals, oil, electricity. Electricity is a commodity and it is traded. Anything that is used is essentially a commodity. The only thing that is actually not used is certain kinds of precious metals, but specifically gold. But it's also used for jewelry. So there's an issue there, but it's an academic debate that's not very important. What's important is that a commodity is an asset that is either grown or mined or created somehow, and then it is then sold, and it is to be used by consumers. It's supposed to be consumed. What are stocks? Stocks are little pieces of ownership of a company. I have a company, whatever that company is, okay, my XYZ company, and I manufacture widgets. And I am the owner of it. I own 100%. But for various reasons, I want to not have ownership of 100% because I want some money for my company, right? Because I've worked at it for 10 years and I'm the sole proprietor of this company, XYZ, but it's doing really well. So I figure I can float its stock. And so what I do is that I legally, by way of lawyers, I take the company and create shares in the company. I create, say, 1 million shares, just for the sake of argument. And what I do is that I have these million shares and I decide that I'm going to sell some of these shares to the public, to any Tom, Dick, or Harry who comes along and wants to buy some shares in my company. Now, since I am the sole proprietor, at this stage, I own all 1 million shares of company XYZ. But I sell my shares in an initial public offering, which the name says it all. The initial public offering is the public offering for the first time of the stock, so anybody can buy it. And suppose, for the sake of argument, that I offer 40% of these stocks, okay? That is 400,000 shares are to be sold to the public. And I sell those shares to the public. Well, each person who buys a stock, they buy 1, 2, 3, or as many as they want, and they have to pay a certain price. Now, since I'm the owner of the company originally, I owned 100% of it, right? And I'm selling 40%, well, all that money goes to me, see? And it might be that I want to sell my company because I want that cash in order to do something else. And since I'm still going to be owning 60% of the company, I still control the company because I have a majority share. And so these 40% shareholders, the shareholders, the people who bought shares, that 40% that I put up for offer, they own pieces of the company, but they don't own all the company. I still control it. And what did I get? I got a boatload of cash. And suppose, for the sake of argument, that the stock went out there and was sold for $10 per share. 400,000 shares times 10 is 4 million bucks. So by doing this, I got 4 million bucks, and with this 4 million bucks, I can go and buy some other company maybe, or use it to start up another company, or just go to Vegas and blow it on the casinos and the hookers and the cocaine. I mean, I could do whatever I want with it because it's mine. You see how it works? You now own a share of XYZ because you own a little piece of it. You bought, say, 20 shares of this XYZ company. You own a little piece of it. That's what a stock is. Now, what is a bond? Oh, unfortunately, I can't fix that. It's at the very bottom of the screen there, but a bond is different from a stock. A stock is a piece of ownership of a company, right? A bond is an IOU. Now, what's an IOU? Suppose you go to the bar, and it's a neighborhood bar and they know you there and, your credit's good there. And you forgot your wallet for whatever reason, and you get there and Dave, the bartender, sees you. Hey, how's it going? And the usual, he says, and you say, yeah, but I don't have any money. Can I write you an IOU? And Dave, the bartender's like, sure, no problem. Just pay me by Friday if you can. Sure, no problem. And he slips you a piece of paper and he writes down what you're gonna buy tonight, or perhaps this is at the end of the night and you've already had a few drinks or whatnot. And he writes there on the piece of paper, 5 drinks, at say $5 a pop, so that's 25 bucks. And you sign this little slip of paper, this little IOU, okay? And you promise to him verbally, because this is 25 bucks, right? You promise verbally to Dave, hey Dave, I promise to pay you by Friday. and I promise to pay you by Friday, and I'll give you a little extra because you're so nice to me. And Dave's happy, and you're happy, and you go home and you forget about the bill until Friday. Friday rolls around, and you whip out $25, put it on the bar. He slides you the IOU, and you just crumple it up and toss it away. And just for his troubles, you slip him another $5 because he's such a nice guy. That IOU, that's a bond. That's all it is. It's a little piece of paper where you, as an investor, you who are buying this bond, because that's what Dave did. He essentially bought the bond, right? He is giving you drinks, and you are giving him a little piece of paper. That's what happened, right? Yeah. I mean, what did Dave get? He got a promise from you, ergo a bond. Because that's what the word bond comes from, promise. It's a promise of payment, an IOU. And all bonds, corporate, governmental, whatever, okay, and we'll see that there are a whole bunch. Bonds are promises whereby the person issuing the bond, issuing this little IOU, promises that at a future date he will pay the full amount for that bond, plus a little interest, okay? That's a bond. Now, real estate, what is real estate? Well, real estate is land or anything built on it, okay? And there are all kinds of different kinds of real estate. There's residential, there's commercial, there's industrial, there's weekend getaways, or houses on the beach or whatnot, or ski chalets. There are all kinds of different real estate, but it's very, very simple. It's basically land and anything on it. That's real estate, okay? Now, well, there isn't a hell of a lot more to say about real estate, but let me start going through these like in order, okay? The simplest ones are commodities. Commodities are traded by way of futures contracts. Now, a lot of you heard probably the other day, but wait, before I continue, just want to make sure everybody following along up to this point, raise your hand, and I'm going to be assuming that if everybody's following along, that the sound is okay. Everybody on board? We're all doing okay? Okay, great. Yeah, because I don't want to be like yammering on forever. I'm putting down your hands. I don't want to be yammering on forever and then suddenly realize that none of you are hearing this or whatever, or, some glitch in the system. Okay, just checking. Okay, so everybody's on board, right? Now, where was I? Yeah, commodities. Commodities are traded by way of futures contracts, okay? Now, I'm going to get into futures options trading in just a little bit, okay? But let me just make it very simple so that those of you who are newbies understand. A futures contract is a contract by which I promise to deliver a certain commodity at a certain place at a certain time in the future, and you pay me now, okay? Suppose I'm a farmer, okay? And I have like a bunch of, soybeans, okay? I got mountains of soybeans here, but I don't have any cash. Now, how the hell am I going to move these soybeans to the market? I sell an options contract, okay? I sell this contract, and I say that in such and such a place at such and such a time, I'm going to deliver these soybeans. And you say to me, but the farmer doesn't have the money to move the soybeans to that market. But that's why he's selling the contract. He sells the contract, gets the cash, and with that cash, he moves all this stuff where it has to be. You see? And he delivers it at that certain price. It's basically a future sale of that commodity. Because he's not selling it now. He has to sell it at the market, but he can't get it at the market for whatever reason. So he sells this futures contract and promises to deliver it. And so from the farmer's point of view, it doesn't matter what happens to that futures contract between the time he issues it and by the time he delivers the commodity. Because see, he already got his money. He sold the commodity. That's what it is. It's selling it into the future. And so what he does is that he sells it now, and he gets that money. Say, for the sake of argument, that to move his soybeans costs him, I don't know, I have no idea. So let's just say, for the sake of argument, it costs him $10,000 to move it over there, right? And he wants to sell all these soybeans for, like, I don't know, $90,000, okay? But he wants to make some profit too, so he sells a future contract for like $120,000. That'll be the price of transportation and the cost of the soybeans, tend to move it 90 to for the actual price of it. And so he expects to earn $20,000 profit, right? Because the actual transportation cost of the soybeans is 100,000 and he's selling it at 120, so he expects to earn that. That's his profit. I'm just making shit up here, just for the example, for the hypothetical. So he sells this future contract for 120,000, and who buys it? A broker. A broker buys it for whatever reason, because what he's going to be doing is he's going to be turning around with this contract and he's going to sell it to somebody who might actually need these soybeans. And who might need them? Supermarkets or some big food conglomerate to make, I don't know, soy sauce or whatever. I have no idea, but you see the point, the mechanics of it. And you say to me, Bill, how do you know this if you don't know shit about the soybean market? Yeah, I don't know anything about the soybean market. I don't know about any of these agricultural markets, but they are all structured identically. That's the point, see? In all commodities, agricultural, industrial, precious metals, they are structured the same, okay? The producer sells it into the future. And this contract floats around and people buy it and sell it for various completely legitimate and reasonable reasons, okay? Like for instance, like an airline will buy jet fuel futures. Why? Because they want to have price stability so that they can figure out how to price their tickets for passengers. Because if the price is going up and down all the time, if they're buying like, every day they're going out there into the market to buy stuff, then they won't be able to financially plan their costs, and therefore they might lose money or not make as much money as they could. And so a lot of times they will buy futures contracts so they can stabilize prices over time, you see? And so different consumers of these commodities have very, very legitimate reasons to buy futures contracts, to fix the price at a certain level and not have the commodity go up and down in price because of the speculation, this, that, the other. Now, a lot of people have heard about how oil was down to negative $40 per barrel. And, some people who don't know very much thought to themselves, ooh, I can quote unquote buy oil and they'll give me the oil plus 40 bucks for every barrel, right? Well, no, totally wrong. Because see, what had happened was that a lot of oil producers in the United States or people who had transported oil from some of the ports, like in Houston and whatnot, had sold futures contracts of this oil that they were going to be getting. Okay, they were going to be getting because they were extracting it from the ground or bringing it by ship. And these contracts, these future contracts, they all specified the same thing, that they would deliver the oil in May in Cushing, Oklahoma. Cushing, Oklahoma is a big oil depot. And so what happened is that all of a sudden, there was so much oil that was going to be hitting Cushing that they ran out of storage space. And so all of a sudden, these traders, not the producers, not the shippers, but some trader, some intermediary who had bought the futures contract at some point in the past, but all of a sudden realized that there was no place to put the oil in Cushing, wanted to get rid of this contract. And so they started lowering the price so that somebody would take this oil off their hands. Because see, this contract obliges the buyer to take possession of the oil at the place and time that the contract says, okay? I mean, it's a two-way promise. If I'm the producer of the oil, I'm in Texas and I sold this May contract in oil because it's the oil that I'm extracting during the month of March, and during the month of April, I'll process it and putting it into trucks and ship it to Cushing, And so I need the cash in April, and that's why I sold the contract in April for May delivery. And I sold it to you as a broker. Well, I have to deliver it to Cushing. I'm legally obliged to. That's the promise I made. If I don't, I can get sued. I can get into a shitload of trouble. Okay. So I'm legally obliged to deliver it. But you, as the owner of the contract, you're legally obliged to take it off my hands. It's your problem now, buddy. And so what happened was that a lot of traders all of a sudden realized that there would be no place to store the oil because there are no airlines flying, no cars driving around because of coronavirus and whatnot. And so all of a sudden they were saying, holy shit, I'm going to get all this oil, and where do I put it? I can't just stack barrels there, because that's not how it works. It is referred to as shipping this in barrels, but it's actually shipped in big container trucks. I mean, big trucks, and through pipelines and whatnot. And there's no storage facility. There's not enough because it's all filled up, and so they got screwed. Okay, so the only way you could ever possibly get free oil plus $40 for every barrel is if you had some empty storage facility in Cushing, Oklahoma, which is, of course, that's not happening. Okay, and so, or if you somehow magically, and within a week's time, when this started happening, this crisis started happening, you had been able to build a container for 100,000 barrels worth of oil within a week's time, and getting, all the environmental permits and all the building inspectors and all the rest of it, and having the thing built in a single week, which of course would have been impossible because those sorts of facilities take, 6 months to 18 months to build for various reasons that are not relevant, but you see the point, okay? And you understand the concept of how commodities are traded, because people who don't understand commodities often think of commodities like oil, like gold, that you take possession of it, and that's very easy with gold, because see, a gold bar of 400 ounces, 400 ounces is, how much is 400 ounces? Let me just break out the calculator, because I'm shitty at this kind of simple algebra. 400 ounces is 25 pounds, okay? Now, 25 pounds, that's a reasonable, you could put a gold bar in your backpack, no problem. Yeah, it's only 25 pounds. But, of course, 400 ounces times, what is it? I haven't checked lately, but say 1,500, that's $600,000, okay? Yeah, a single bar. And so people think of commodities in those terms. But see, wheat, soy, oil, have you ever seen a barrel of oil? A barrel of oil is rather large, and sells for, right now it's selling for $10. I mean, this is like physically a lot, okay? And so you need these futures contracts in order to trade in this stuff, because you need to move it around, okay? But ultimately, you have to be very, very careful with commodities, because see, it is something physical and very, very large. And you see what happened to these poor bastards in the oil markets, right? They wound up, they would pay somebody to take this contract off their hands. That's what essentially was going on. But anyway, going back to this thing, I'm going into a little bit of a rabbit hole with each of these asset classes, because I want you to get an understanding of each of these asset classes. Now let's move on to stocks. Stocks, of course, do not have the problem of commodities, because stocks are just bits of paper, okay? Do keep in mind, every company has actual physical pieces of paper for the stock, and same for bonds, by the way, okay? What happens is that many times for stocks and bonds, there is a custodial agent, that is a person who is going to hold on to these assets, the physical stock piece of paper, the physical bond piece of paper. And what will happen is that it will be traded electronically. But if you go through all the electronic trading, you will eventually find somebody who actually has it. And they charge, fractions of a cent to hold stock, because of course it's just bits of paper. In a file cabinet, you could probably store all the stocks of Apple Corporation, for instance. I mean, it's just bits of paper. Okay, so it's not like commodities where you have a big problem because it's so big. You don't have that problem with stocks, and so ergo you will never have the kind of situation that I discussed with the oil, right, with the negative oil prices. Stocks are just bits of paper, and the system is so old and tested by time and robust that nobody really worries about it, okay? And nobody really should, okay? So don't freak out about it. Anyway, let me get into the specifics of stocks. See, in stocks, like I said before, stocks are a piece of a company. You are part owner of that company. You own one share in Apple stock, right? That means that you're an owner of Apple. You are one of the owners of potentially millions. I have no idea how many people own shares of Apple Corporation, but let's just say for the sake of argument that it's 100,000, fine. You are one of the 100,000 people who own, or more, probably a couple of million people own shares in Apple. You are a part owner of Apple. Yeah, because that's what a share is. But a bond, if Apple issues a bond, then Apple owes you money. Okay? That's the difference. Stocks, you are an owner of the company. You own the bond, that company owes you money. That's the difference. Okay, now stocks. Stocks usually emerge by way of IPOs. That's it. That's initial public offerings. Okay? That's when a company goes out into the public and say, hey, here I am. I want to sell pieces of myself because the owners want that money to do other stuff. That's ultimately the only reason that you would offer a company to the public. Okay? Many times an owner will sell pieces of the company because he wants that money to come in so that he can improve the company. Okay? That often is not, that's how people do it. Okay? Not always. Sometimes people want to sell shares in the stock because they realize that, this is as far as they go. Sometimes what happens is that the owner has decided that he really doesn't want to continue with the company. And so what he wants to do is he wants to float it, have other people start buying it, bring in a professional management, a professional board of directors and whatnot, and gently exit the company, okay? Because you have to keep in mind something. Stocks were invented in the early 17th century in Amsterdam, as a matter of fact. The East India Company was the first corporation, a corporation that issued stock, okay? That is partial ownership. This was essential, and this was a turning point historically in capitalism, in world history, I would venture to argue. Because in the past, see, if somebody had a little business, whatsoever that business may be, he was the sole proprietor of it. If you were a cobbler, if you were a miner, if you were whatever it was that you were the sole owner, and there was no way for you to transfer ownership of the company except to another single proprietor. Okay, maybe you could sell it to a partner or a partnership. But see, with stocks, when they were created, this was the first time where you could transfer ownership of a company without affecting the company. Because you see, think of it, if I'm a cobbler, that is, I fix shoes for a living, and I have a little shop, I own the little shop, say, and I have this little shop, and I have maybe 3 or 4 people working for me. And I actually don't fix any shoes, right? I just manage the thing. And I have 3 or 4 workers fixing shoes, and I have a steady clientele, and it's a money-making business, right? But this is before stocks, right? So I'm the sole owner. So how do I sell this? I have to find one guy who wants to do what I'm doing. You see? And I have to sell him the company, and this will inevitably disrupt the operations of the company because this new owner will come in and he will be the owner manager, and he will probably change workers or want to change locations or this, that, the other, whatever the reason, it will disrupt the business. You see? Now, of course, I could potentially bring in a partner and slowly transfer ownership to him, and he pays me somehow or other, and that'll take quite a while, right? Or I could transfer it to my son. And these are the ways that people used to transfer a business. It would be, they would transfer it to their son or transfer it to a partner, or in worst case, try to find some buyer and sell the whole business, but that was exceedingly rare, see? And many times when they tried to pass on the business to their son, the son wasn't really interested. So he'd be stuck doing something that didn't like, and because he didn't like it, he probably wasn't any good at it. And so it was like a big old mess, you see? So transferring a business from one owner to another was exceptionally difficult until the Dutch invented stock, because it's an invention, it's a technology, and it's a very brilliant technology. And because what happens is that, you see, you can sell shares in the company, and those shares can be transferred between people, and it will never affect the operations of the company, you see? And think about it. I'm owning Apple shares. I own 100,000 shares. Okay, I'm just making up a number. And I own 100,000 Apple shares,
and you want to buy my 100,000 for whatever reason. Or maybe you're just one more buyer of a whole bunch, right? So what do, I just go out to the stock market and say, hey, I got 100,000 shares of Apple. I want to get rid of them. Who wants to buy them? And a bunch of people show up and they buy them. And they buy all my shares and I get cash and I walk away and they walk away because they got shares of Apple. Is Apple affected by this transaction? No, it is not. Of course not. Because a bunch of people bought and sold their shares. Apple could give a shit. Tim Cook, he's not even thinking about it, right? It doesn't affect the business, and that's the genius of stocks. That's why they're so important to business in the West, because it allowed companies to develop and not be traumatized by changes in ownership. And it allowed for professional management to be inserted into these companies, you see? So anyway, setting aside that little history lesson and sort of like a little insight into stocks, which is very important so that you can understand it better, okay? A stock, usually what happens is that a company issues dividends. Dividends are basically the earnings of the year. Think about it. You know, a company makes money, makes a lot of money, you know, say $100 million. An XYZ company made $100 million, right? So it says that it's going to issue dividends to its shareholders. What does that mean? It means that it's going to pay a little bit of those $100 million that it made to each of the people who own shares in that company, in XYZ. Say, for the sake of argument, that XYZ issued 1 billion shares. Again, I'm just making this up. It issued 1 billion shares and it had net income that it's going to distribute as dividends of $100 million. So how much is that? Well, $100 million divided by a billion shares, is 0.1, i.e. 1/10 of a dollar, i.e. 10 cents. So everybody who owns a share in XYZ is going to get 10 cents. Now, this is actually pretty good if, for instance, the share price is, say, $5. I'm just making it so that the math is not funky, okay? If each share is $5 and there are 1 billion shares, that means that the company is worth $5 billion, right? If it has, the share price is $5 and it issues dividends of 10 cents, well, 10 cents divided by $5 is what? 1/50th. Oh, it's not so good. It's 2%, but okay, it doesn't matter. 2% yield. That's the yield. That's the dividend yield, okay? Dividend yield, because it issued 10 cents for every share, and the average share price is $5, so 10 cents divided by $5 is 0.02, i.e. 2%. That's the yield. Now suppose, for the sake of argument, that XYZ company issues dividends every quarter. There are 4 quarters to the year. Each quarter is the equivalent of 3 months. If the company issues dividends every quarter, at the end of every quarter, that would be March, June, at the end of September and December, right? Okay, if it issues dividends at the end of every quarter, and it issues 10 cents for every share every quarter, well, 10 cents on the first quarter plus 10 cents in the second, 10 cents in the third, and 10 in the fourth, that's 40 cents. 40 cents divided by $5, how much is that? That's 0.08, i.e. 8%. That would be the yearly yield of XYZ stock. You see? 8%, which is pretty good actually. Okay, but you see how it works. Some companies issue dividends. Nowadays, very few, and for reasons that I will explain much later. Dividends, okay. But how do you look at how, let me rephrase this. How do you figure out if a stock is fairly priced? Okay, this is hard. Because you see, some companies are starting out and they might not be very profitable, but they have a lot of potential. Some companies have been around for 100 years and their business, their whatever they're doing is very well known, okay? So you have to figure out what's called the price to earnings ratio. The price to earnings ratio is very simple. you look at how much money the company makes. Before I talked about dividends, that the company had made money and it issued dividends, but suppose for the sake of argument, in this case, it's not going to issue dividends. We're only going to look at the net earnings, okay? To figure out the price to earnings ratio, you have to look at the earnings of the company. And the earnings you look at is very specific. It's called EBITDA. I should have noted down here. EBITDA, earnings before interest, taxes, depreciation, and amortization. Okay, sorry, I forgot how to spell it, but I'll say it out to you. Earnings before interest, taxes, depreciation, and amortization. Okay, think of it in these terms. See, it's all the money that a company brings in is called revenue. But of course, that revenue has a cost. For instance, if you're a car manufacturer, you have to buy the metal and pay the laborers to make the cars, right? So your revenue can be, say, $1 billion, but your costs to make that product, whatsoever that product, you have to take it away, okay? Because the revenue is not how much money you earn. The revenue is just the money that comes in. The income or the earnings, that is the money that comes in after costs. So let's say you bring in $1 billion, that's your revenue, your gross revenue, and say labor and materials is 600 million, okay? So your earnings before interest, taxes, depreciation, and amortization is $400 million on revenue of $1 billion. Now, I say earnings before interest, taxes, depreciation, and amortization, because you see, a company also has certain expenses that it has to pay that are separate from its the cost of operations. Okay, and those are interest, that is the interest it pays on any outstanding loan, including bonds. Interest. It has to pay taxes. Of course, everybody has to pay taxes. It has to pay depreciation and amortization. Okay, depreciation and amortization are concepts in accounting. Depreciation is how much money the piece of factory equipment loses every year. Because you see, if you have like a robot in your factory floor to make cars, right? That robot, it costs 100, and every year, and it only is going to last for say 10 years. And so that is the depreciation. See, it's going to last only 10 years, and by the end of the 10-year period, it's going to be worth 0. So that means if it costs 100, you divide it by 10 years, and that's $10 per year that it goes down in price. And what is depreciation used for? It's used to minimize your taxes. Because see, it's not fair that if you purchase something and it's going down in value, right, that you don't, in terms of accounting, show that cost because it's being removed from your income, okay? And so that's why depreciation is used. Amortization is similar, but for other projects. So anyway, the point becomes that earnings are always earnings before interest, taxes, depreciation, and amortization, EBITDA. The price of the stock, okay, let me rephrase that. The earnings divided by the price, okay? Now I realize that I'm always wondering, why are they doing it P and E when it should be really E and P? But anyway, it's the earnings, the EBITDA, earnings before interest, taxes, depreciation, and amortization divided by the price of the stock. For example, suppose we talked before about the XYZ company, right? Suppose it has an earnings of, well, let's do a different example. Let me come up with something completely different. The MNOP company, the NOP company, NOP, great. The NOP company has earnings before interest, taxes, depreciation of say $2 a share, and the share price is 100. Now, by the way, EBITDA is calculated yearly, not quarterly or semestrally or monthly or anything like that. You're always talking about, when you talk about EBITDA, you're talking about yearly. When you're talking about price to earnings, you're talking about yearlies, okay? Okay, so the earnings divided by the price of the stock, it's, what did I say? It was $2 per share. And the price of the shares right now is 100. 2 divided by 100 is 2%. Okay. That's the yield. Okay. Price to earnings ratio is mathematically identical to yield. You don't call it yield. Okay. Because it's not an investment where you get those earnings. Because if the company releases dividends, that would be calculated as yield for you as an investor, okay? Because that's the money you're actually getting by owning this piece of the company, by owning the share. But insofar as price to earnings ratio, mathematically it is identical to a yield. The difference is that the earnings many times do not go to the owners of the company, i.e. the shareholders, but rather are recirculated and plowed back into the business, which is in fact very normal for most businesses. Most businesses, what they want to do is that use their earnings in order to improve the company and become bigger and make more money, okay? That, for instance, famously is what Amazon did. They didn't have any earnings. They would plow it all back in, okay? And they didn't have any profits because of it, because they were just building their platform, building their business model, okay? So anyway, the price to earnings ratio, that's how you can tell how if the value of the company is reasonable, okay? Because in the case of a company, NOP, that I said that it was $2 per year of earnings over a average share price of $50, well, or $100 rather, that's 2%. That's very low, okay? The price to earnings ratio there is 1 to 25. The fact of the matter is that over the last few years, for reasons that I'm not going to get into right now, that I will explain, I'm realizing now in a separate webinar, the average price to earnings ratio in the stock market in the United States and the Dow Jones and the NASDAQ was astronomically high. Insofar as the NASDAQ, I think was 35 to 1, and the Dow Jones, it was something like 27 odd something to 1, okay? Absurd heights. A reasonable price to earnings ratio when I was growing up, when I was learning about all this shit, like in the late 70s, early 80s, I was about 10, 13 years old, around that age. That's when I picked up all this stuff. Well, at that time, it was reasonable if it was 10 to 1, maybe 12 to 1, okay? 10 to 1, 12 to 1 price to earnings ratio. That was considered reasonable. And something that was, say, 17 to 1, 20 to 1, that was way overpriced. That's what people thought back in 1980, okay? And for various reasons, everybody started speculating over the last 40 years. And now people don't bat an eye when they hear that a company has a price to earnings ratio of 35 to 1. They don't bat an eye when they hear that the price to earnings ratio is negative because the fucking company is losing money. Like for instance, with WeWork. WeWork is a famous company that lost a shit ton of money in its business model, and yet people thought that it was a valuable company, an exceedingly valuable company, which is insane. Okay, it was a negative price to earnings ratio because they were losing money, not winning money, not earning money consistently. Okay, so anyway, to figure out how accurately priced some stock is, you have to look at the price to earnings ratio. But you also have to understand that sometimes a company is in a very new business where there's a lot of growth potential and potential future profitability. And you should look at, see if maybe the company is in a mature market, it's a mature business, see? Okay, I just want you to understand the whole notion of price to earnings ratio, because that's the way you can figure out the true value of a stock and ergo true value of the company, okay? Yeah, a couple of terms that just so that you know what they are. They're not important at this point, but just so that you know. Stock buybacks. Stock buyback is when a company goes out into the market and buys its own shares back for whatever reason. Usually it's not a good reason, okay? Usually they're trying to do something hinky, okay? A lot of times, or let me phrase that, as of late, a lot of companies have been on stock buyback sprees, because if you go out into the market and buy back your own stock, inevitably the price of the stock rises. If a price of the stock rises, many CEOs, many people on the board of directors, many financial officers, people in the C-suite, basically, they get bumps in their bonuses. And a lot of companies have been going on stock buybacks just to make the people at the top of the company get bigger bonuses. It's really fucking despicable, but it's happened all over the fucking place, okay? And the way a lot of them are doing it is by issuing bonds, i.e. going into debt in order to get cash, and they turn around and buy back stock in their company, and they get a bigger bonus, and the company is saddled with debt. You know, it's stupid, but you know that's what's been going on, and the authorities haven't been saying shit about it until now, when it's sort of like too late. So anyway, a stock split is when sometimes, for various reasons, the company decides that every share of the company is going to be split into two. And so, for instance, if you have a share that's worth, say, $10, it will be split into two shares, each worth $5. So you, the net owner, are not going to be affected. A lot of times, the company will do this in order to issue more stock, because many times the company itself owns shares in itself. And what it does is that it turns around and splits stock, either 2-to-1 or 3-to-1 or 4-to-1, it doesn't really matter. And it's just a way to conveniently sell more shares. A lot of times companies do this in the hopes that they will split the share price, and the share price will go back up to close to what it used to be, which happens a lot. It's taking advantage of a psychological bias that buyers have, that traders and investors have. Okay, a reverse split is when a company will say that, for instance, that 2 shares of a stock will vanish and be replaced by only 1 share. Okay. And often as not, they do this in order to prop up the price of the share, because they don't want it to be that low for PR reasons, basically. Example of this, and something I watched firsthand, was Citibank. Back in the day, Citibank fell in price all the way to about less than $1, as a matter of fact. It fell to 93 cents per share. And I know this because I bought it at 98 cents per share, because I calculated back in 2008, late 2008 rather, that the federal government would never allow Citibank to go bankrupt. They would bail it out no matter what, because it would be too much of a psychological blow to the markets if Citibank, the world's biggest bank, commercial bank, were to go belly up. And of course, that happened. They bailed it out. And so what happened is that Citi share prices fell to 93 cents. I bought it at 98. This was the best trade of my life, by the way. And I've talked about this many times before. I purchased it at 98. It fell all the way to 93, 94, 93. And then it bounced back up, and it went right on back because of the government bailout to about $5 per share. And I exited the position shortly before what happened next, which was when it was at $5 per share. It sort of like floated there in that region for a while, and they decided to do a 10-to-1 reverse split. They decided that they were, for everybody who had 10 shares, those 10 shares would be combined into a single share, and therefore the price of the stock would be multiplied by 10, right? Because they wanted the share price to be worth $50, not 5. Because 5, it just, for PR reasons, it looked penny ante. They wanted it back at 50. It was a totally cosmetic move. It had no inherent reason for being, but they did it just for PR reasons, which is, well, they did it, and that's the way it is, And so anyway, I personally don't see much of a reason for reverse splits other than PR. Okay. Now, bonds. Now let's talk about bonds a little bit. Oh man, I've been going on for an hour, and I'm still not, I'm barely halfway through. Sorry about this, but there's a lot of stuff here. Okay. And I hope that you've been taking notes and following along, and I hope that my explanation so far has been, well, let me ask you guys, let me put everybody's hand down. Everybody more or less get what's going on? Raise your hand. Raise your hand. Or better, that's a bad question. Bad question. Let me put everybody's hand down. Don't press the button until I ask the question. Who does not know what I have been saying so far? Does not understand it? Okay. Okay, let's go to Karsten. Karsten, hey, how's it going, Karsten?
Hello, you there? Karsten? I guess Karsten isn't there. Uh, there's a guy called Kaka Zumba. Kaka, how's it going? You there? Hello, Kaka? You there?
Yes, I'm right here. Can you hear me?
Yeah, I can hear you fine. What's up? What is
Yeah.
not clear so far?
Yeah. Do you mind explaining more about the EBITDA?
Yeah, okay. EBITDA. Sure, no problem. See, earnings before interest, taxes, depreciation, and amortization. These are accounting costs that have to be factored into the earnings of the company. They are not operational costs. That's the difference, okay? Because see, net earnings are revenue minus operating expenses, interest, taxes, depreciation, and amortization, okay? That's net earnings. That's the end line, the bottom line, the very last line. It's before all the other expenses. There's costs of operation, i.e. raw materials and labor, right? But then there are these accounting costs like taxes, like depreciation, like interest payments. Those are costs that are not related to the business, but that have to be covered, okay? So a lot of times when you look at EBITDA, the EBITDA number, that is a better reflection of the true health of a company. Because a lot of times a company might have a lot of debt, a lot of interest payments. It might have a lot of taxes, a lot of depreciation, amortization, whatnot. But the business itself is very healthy. See, you want to be able to look at the number that will tell you the actual health of the company without looking at the expenses that it has that are unrelated to the health of the company. That's why EBITDA is so important. Okay? Okay. So let me move on. Let me get to the issue of bonds. Yeah. Bonds, like I said before, are IOUs, right? Like I explained in the example of Dave and you going to have a drink there or several drinks one day and paying him by Friday. Yeah, that's a bond, right? Now, the terms that you should know about bonds, there are four basically: yield, maturity, coupon, rating. Those are the four terms that you have to learn, and they're very simple. Yield, as I've said before, is how much money you get from the bond, okay? The maturity is the length of time of the bond. In the example with Dave, right, you wrote that little IOU paper, and suppose today is Sunday, right? So you promised that by Friday you'd pay him, so that's 5 days away from now, because right now it's Sunday evening where I am. And so Friday would be, Monday, Tuesday, Wednesday, Thursday, Friday, 5 days. That IOU has a maturity of 5 days. In 5 days' time, I have to pay him that money, the money that I borrowed from him, right? That's what's written on the IOU. The coupon is the interest payment, the extra. And the rating is how solid the bond is, okay? The rating is determined by a ratings agency that looks at the company issuing a bond and determines how creditworthy they are, okay? Now, I'll explain all this, and it's very simple, okay? Suppose I am a company and I need to build a factory, okay? Now I'm a company and I have, say, $100 million worth of earnings over, say, $500 million in gross revenue. That is my gross revenue. All the money that I bring in through my company is 500 million. And after all operating expenses, I walk away with $100 million. That's pretty good. Okay. So that's, by the way, that's EBITDA. That's earnings before interest, taxes, depreciation, and amortization. Okay. Okay. So after operating expenses, I get $100 million, right? Now, $100 million is a lot of money, but I want to build a factory. Now, this factory, it's going to cost me $1 billion. I don't have $1 billion. No way. Okay. And my gross revenue is 500 million per year. Okay. So that would mean that in order to get $1 billion, I have to sell my products for 2 years
and not pay anybody, not my workers, not my suppliers, nobody, not pay them anything. I'd have to hold on to those, all that revenue, and not pay my workers, not pay my suppliers, not pay the raw materials for my widgets, whatever they may be. And at the end of 2 years, I have enough money to build the factory. Now, of course, that's absurd, right? I mean, you can't run a business that way. You have to pay your workers, you have to pay your suppliers, you have to pay the raw materials for your widgets, right? So how do I get $1 billion to build the factory? Well, if you're an ordinary person, you'd say, oh, I can go to the bank and get a loan. Yeah, but $1 billion, that's a lot of fucking money, right? It's a lot of money. And are there that many banks that have that kind of money? Well, yeah, actually there are, but a bank, if you just go to a bank, they're going to charge you all kinds of fees for this transaction, not to mention the interest payments, right? So what do? Well, instead of going to a bank, which is going to cost you an arm and a leg, I mean, easily they could charge you, say, on top of that billion, they could charge you, say, 250 million, 25% on top of the money that you're actually borrowing, right? It would be crazy to do that. So what do? You go to investors, just guys with money, okay? And not guys with $1 billion, no, guys with have maybe 100,000 to invest or 200,000 or maybe $1 million to invest, right? And you issue bonds, okay? You issue bonds. What you say is basically you print up bonds that, a million bonds, and each bond is worth $1,000, okay? A million little slips of paper, each of them that say, this bond I owe you is worth $1,000, okay? And in that bond, you put certain conditions, okay? You say that you're gonna pay back the money in, say, 10 years, and you're gonna pay, say, 5% per year for the bond, okay? Now, this is totally hypothetical. Write this down so that you can follow along. You're going to issue $1 billion worth of bonds with a maturity of 10 years and a coupon of 5%. A coupon and interest, insofar as a bond, is essentially the same thing. Where does the word coupon comes from? Well, before, in the past, see, bonds would be printed, and the piece of paper would be printed, and below it there'd be a bunch of little stamps. Okay, I swear to God, that's how they were done in the 19th century, especially 19th century, early 20th century. And these bits of paper, they would have at the top would be the bond, and it would be this big piece of paper that says, the name of the company issuing the bond, and then it would say, $1,000. And below there'd be these little coupons that would be like for 5% and 5% per year, right? For $1,000 is what? $50. And so there'd be, 20 or 10 coupons of 10 little stamps of $50 each. And what you would do is that you would tear off that little stamp at the appointed time, because each of those stamps would represent a specific year when that company would make good on that stamp. And you'd tear it off, put that stamp in an envelope and send it off to the company, and the company would send you back the money. Yeah, that's basically how it worked in the past, right? Or you went there and delivered it, didn't matter, okay? But that's the form in which it happens. That's why the word coupon is still used. The coupon is considered the interest on the bond, on the loan, okay? And the maturity is how many years is the loan. So the company, my company, is issuing $1 billion worth of loans. It's going to issue them for 10 years. What did I say? $1 billion worth of bonds, right? It's going to be 1 million bonds of $1,000 each. So that means the minimum that you can buy of these bonds is $1,000, right? It's going to be a 5% coupon. That is 5% every year. I will pay 5%, right? And yeah, it's got 10 years maturity. Okay, so I issue this bond, right? Now my company, suppose for the sake of argument that my company is really, really solid. It's as solid as can be, as solid as houses, right? I am going to get a AAA rating from the ratings agencies. There's Moody's, there's S&P, and these companies, what do? They analyze companies and see their credit worthiness. Just like a credit rating agency has your credit score. You personally, you guys who are listening to me now, if you want to get a loan, if you have a good credit rating, right, a good credit score, you get a lot of money for low interest. But if you have a crappy credit score, you get little money in credit and they're going to charge you a lot of interest. You see how it works? It works exactly the same for companies. It works the same for governments also, which I'll get to in just a moment. Okay, so the four terms you have to understand is yield, maturity, coupon, and rating. Now, here is where a lot of people trip up, okay? Before we get into the different kinds of bonds, you have to understand the issue of yield insofar as a bond is concerned. Because a bond, I issue a bond for $1,000, right? I issue 1 million bonds for 10 years, you know, you add it all up, it comes to $1 billion, right? I'm the company that issues these bonds. I issue these bonds, I sell them to investors. I sell them to each of you here. I sell each of you $10,000 worth of these bonds, and I sell a few more bonds elsewhere, here, there, the other, you know, and what do I get? I get cash. I get $1 billion worth of cash, right? Because I sold $1 billion worth of IOUs. That is $1 billion worth of bonds. And I get $1 billion in cash. What do I do with this cash? I turn around and I build my factory. See? That is the use of a bond. You are taking out a loan with investors so that you can buy something that will make your business better. And if you're a government, you do the same thing, except instead of like building a new factory, you use a bond issuance to say, build a bridge, okay? Build a bridge, and what's your income if you're a government? Well, your tax revenue, of course, you see? Because you're bringing in taxes. And with those taxes, you use those taxes to pay for public employees, you use those taxes to pay for street repairs and whatnot, but you also use it to pay the interest on these bonds that you issued to build the bridge, because the bridge is very expensive and your tax revenue per year is not enough to cover it. So you issue government bonds to bring in this cash so you can go and build a bridge. You see how it works? Yeah, it's for capital improvements. That's what it's called. You issue bonds, in the best case scenario, for capital improvements. You don't issue bonds to, you know, get a bunch of hookers and a lot of cocaine and have yourself high all the time. No, you issue bonds to get cash so that you can buy something or pay for something that your normal revenue is just not enough to cover because it's too big of an expense. You see? I mean, think of it in these terms. So you need a new computer for your office, right? What's that, a couple of grand, right? Of course, you're going to be able to pay for it. Yeah, it's not strictly necessary for the operation of your business, but it's an expensive business expense and it goes right in. But you want to build $1 billion factory, you ain't going to have enough cash for it. You want to build a bridge, if you're a government, you're not going to have enough cash. Sure, you have enough cash to buy a new computer, maybe computers for everybody, right? But not for some big ticket item. That's a capital improvement, you see? Okay, so what happens is that here is where people fuck up insofar as understanding yield with regards to bonds. I issued a bond, $1 billion worth of bonds at $1,000 each. I sold these bonds, right? Bonds are traded by investors. They are bought and sold by an investor. And here's the thing. The price of the bond changes because of how risky or not risky the company is perceived to be. And that change in price is reflected in the yield. Now, I know this is a lot, so bear with me. In the example, I sold my bonds for $1,000 each at 5% coupon. Okay. Now, in this case, I want you to pay very close attention to when I say the word coupon, because coupon here, I've said that yield and coupon are the same thing. But excuse me, yield and interest are the same thing, and this is accurate. Okay. The coupon, the interest, that is what the money that the bond is going to pay for every period, for every year or quarter. Each bond is different in that regard. It could be quarterly or it could be yearly. It's not important because the coupon is always referred to on a yearly basis, okay? Okay, so what is the yield when it's pristine, when I just issue it? The yield is the coupon divided by the face value of the bond. The face value of the bond, what's printed on the bond, is $1,000. In 10 years, if you show up with this bond in your hand and you show up to my office, I will take that piece of paper, that bond that says $1,000, and I will put on the table in front of you for you to take home. I will pay you exactly $1,000. But that's in 10 years, not now. See? In 10 years, if I'm still around and you're still the owner of the bond, I will pay you $1,000 because that's the promise I made. That's the bond we have, right? The promise made between us. You hold on to that little piece of paper, and I promise to pay you in 10 years, by the year 2030, $1,000. But say that you decide that you pay $1,000, paid it to me, and I go and build my factory, but you have the bond, and for whatever reason, all of a sudden, you need $1,000. You need to get rid of this bond. Not because you're scared of the bond, not because you don't trust me, my company, whatnot, but simply because you need cash or for whatever reason, okay? Or maybe say, some people are saying, man, you know, the company that CRP is building, man, it's a gangbusters, it's really dependable, you know. I'd be willing to pay $1,010 for the bonds that CRP issued. And so you say to yourself, well, I'm gonna sell my bond because I'll make $10 off it. You see? And so you sell the bond. You sell it to some other guy, some other investor, okay? Now, what has happened in that situation? Suppose, for the sake of argument, that it's 5% coupon and $1,000 face value, right? $50, you know, that's the coupon. It's 5%. That's the yield. The coupon, $50, divided by the face value, $1,000. That's the nominal yield. That's the yield when it's issued, the nominal yield. The actual yield is the coupon divided by the current price of the bond. Okay? Now, the coupon is always fixed because it says on the you know, it's going to be $50 every payment, which is going to be yearly, right? Suppose that the bond goes up in price. What happens to the yield? It decreases, okay? And let me show you, let me show you. Take out a piece of paper, and if you have a calculator, that'd be great. $50 divided by 1,000 is 5%, right? That's the yield, the nominal yield. Suppose that $50 is the coupon, but the bond goes up in value. It goes up to 1,100. So that's 50 divided by 1,100. What's the yield now? It's 4.54%. Repeating, okay? It's 4.54, 54, 54, and to infinity. Now, 4.54 is lower than 5%. The yield went down because the price of the bond went up. Now, why would it do that? Why would the yield go down? Why would the price go up? Because what happens is, suppose you lend money to somebody that you're not really sure is going to pay you back. You're going to charge them a lot of interest, right? Of course you are. Suppose, you know, like in the beginning example, you know, Dave, you know, floats me some drinks, you know, and he knows I'm good for it, right? And so he says, you know, yeah, sure, you pay me back $25 by Friday. No problem. And I'm a good customer. He knows where I live, you know, and he knows I'm not going anywhere. He knows I got a good job. I make good money, no problem, right? So he's going to charge me very little interest, say 2%, okay? 2% of $25 is what, 50 cents? Yeah. So, you know, I come back on Friday, slap down the $25, and I slap down the 2% interest that he's charging me. But suppose that I'm not, you know, a dependable fella. Suppose that I'm like a bum living on the streets, a drunk, right? How much is Dave going to charge me in interest? Well, shitloads more because there's more risk. You see? Yeah, the more risky, the more interest. You see how it works? So for instance, if I'm like a drunk and you know I'm drunk all the time and I'm a homeless guy, right? What are the odds that I'm going to pay him back by Friday the 25 bucks for the drinks that he's floated me? Not that much. So he's going to charge me a lot of interest, say 20% interest. You know? So in order for me to do this, in order for me to get drinks from Dave, I have to agree to pay 20% by Friday. You see? Now blow this up to corporations. Suppose I have a very, very solid corporation like Apple or some shit like that. The interest is going to be very low because everybody's going to be confident that I'll pay it back. And in fact, suppose that I issue these bonds with a coupon of 50 and the face value of 1,000, i.e. a nominal yield of 5%. And you know, hell, you know, I come out with a new product that is gangbusters. I don't know, like an eye headband that everybody wants to wear my electronic headband, and it's like the latest thing, you know, and everybody's doing TikTok videos about the fucking Apple eye headband, right? Yay, Apple is going to make a shit ton of more money. And so what happens? People realize, holy shit, this company is even safer. And so the price of the bond goes up because people realize that it's so safe that you can buy a bond and you are sure to get the coupon every year, and you are sure to get the $1,000 at the end of the period. And therefore, what happens is that, see, they're willing to pay more money to get less return on the investment. Because remember, that's what the yield is. It's return on investment, see? When I issued I'm Apple, I issued the $1,000 bond, right? And $50 coupon, i.e. 5% yield, 5% nominal yield. Nominal is what's the face value of something. And now companies are willing to take just 4% yield, 3.5% yield, i.e. they are willing to pay more for my bond because I'm so credit worthy. I'm such a sure thing that they are willing to take less interest because that's what it is. It's interest, you see? And that's why the price of a bond will go up, because as some company becomes more and more credit worthy, more and more dependable, you are more and more confident that you will get paid back, then you are willing to pay more for that security. Now, of course, on the flip side of this is that, see, what happens if you're a company, a really great, you know, an Apple company, right? But things go south. You release the iBand, the iHeadband, and it's a big old flop, and it costs you $100 billion to develop this thing, and nobody wants it, right? Holy cow! All of a sudden, Apple is in trouble, right? And so what happens to the bond prices? They go down. Of course, they go down. They were nominally 1,000, but now that's being traded at only, say, $900. Not 1,000. It went down 10%. And what's that? Well, the nominal, the coupon was 50, right? Divided by 900. What's the yield? 5.555%. You see? The greater the yield, the riskier the bond. The lower the yield, the safer the bond. A government 30-day piece of paper, sometimes they call bonds pieces of paper, they call them paper, government issued paper. A 30-day government issued paper, the government many times issues 30-day bonds for various reasons, practical reasons I'm not going to get into here, but it's perfectly reasonable for them to do so sometimes. It'll be, you know, a fraction of a percent because the government isn't going to go anywhere in 30 days, okay? It's going to be so low, the yield is infinitesimal, okay? But a company that's really risky, that might go tits up, like say, for instance, some airline company right now, yeah, you can have it yielding 10%, 15%. Those are called junk bonds. A junk bond is measured by its yield. The greater the yield, the more junk it is. The lower the yield, the more investment grade it is. Because what happens is that if its yield is very low, it's because the market considers that company that issued those bonds to be very dependable, very safe, very low risk. And so credit rating agencies look at those companies and they see that the company is very dependable, they have a lot of cash on hand, and that they are going to make their interest payments and they'll eventually make good on the bond when it matures in 10 years, right? And so they give it a classification. Apple, for instance, is investment grade. It has AAA rating across the board. Every ratings agency knows that Apple, which will issue bonds for very legitimate reasons, is good, is going to make good on those bonds. So of course it's going to be investment grade. Why does this matter? Because an investment grade bond, pension funds and insurance companies will buy those bonds. Because see, pension funds and insurance funds, they will want bonds that will give them income, a steady income. And so, for instance, we're looking at Apple, and Apple has bonds that are, yielding, say, 3%, and you say, well, that's so little, 3% a year. Yeah, but it's safe. That's the point. That's the beauty of it. It's safe as houses. Apple isn't going to go broke. And so, of course, a pension fund will buy Apple bonds because Apple is a dependable company. It will be here in 10 years and it will make good on its debts. No problem. But some other company, some airline company, for instance, well, it's junk. It's junk and its yield is going to be exceedingly high. If Apple's yield is like 3% or 2% even, I have no idea. I'm just making it up. Some airline company that's about to go broke, its yield is going to be 15, 20%. Yeah, it's going to be through the moon because everybody knows that it's not dependable. It might make good on its payments. It might make good on the bond itself at the end of its maturity, or it might not. So its yield is high and its price is low. See, the yield and the price are inversely correlated by definition, okay? The lower the price, the higher the yield by definition, because the coupon is fixed. That's the point. It's fixed at the moment that the bond is issued, okay? Okay. Now, there are corporate bonds and there are government bonds. Government bonds, not just the United States, if you're American, every country issues bonds. In the United States, they actually issue a whole bunch of bonds. They issue treasury bonds. Treasury bonds are issued by the federal government. That's why they're called treasury bonds. There are state bonds. Every state issues bonds. California, Nebraska, Arkansas, Florida. They each issue their own bonds. There are what is known as agency bonds. That is, agencies within the federal government issue their own bonds for various reasons, okay? That is completely separate from treasury bonds, and they are administered separately from treasury bonds, even though they are totaled as the total federal government debt, because these federal government agencies and treasury agency, treasury department, they're all of the federal government, right? And finally, there are municipal bonds. Now, municipal bonds are very interesting. Municipal bonds are obviously issued by municipalities. This is all in the United States, by the way. I'll talk about sovereign debt in just a second. Municipal bonds are unique because the interest payments on municipal bonds are tax-free. And so if you buy a municipal bond and you get interest payment from the municipality for that bond, well, percentage-wise, it's not going to be any different from the treasury bonds or agency bonds or state bonds. But since you don't pay taxes on the income that comes from the municipal bond, it's effectively a higher yielding bond. The United States government, by way of the IRS, has written in this tax-free income from municipal bonds precisely so as to foment people investing in municipalities, their own municipalities especially, so that the local government can improve the locality. Municipal bonds, like I said before, are used to build bridges and schools and shit like that, okay? And so this is an elegant way so that the United States government does not have to shell out money to build these bridges or build these schools or build these local hospitals. The local government can do it and people will be happy to lend them money because Number one, these municipalities, the income from these municipal bonds do not pay federal income tax. And number two, these municipal bonds are usually backed by the United States government, by the federal government. So even if the municipality goes broke, which has happened occasionally, ultimately anybody who is invested in municipal bonds will be made whole, okay? Made whole means that they're not going to lose any money. So that's the advantage of municipal bonds. Now, sovereign debt, every country issues sovereign debt. Sovereign debt, government bonds, the same thing, okay? The countries that issue debt, like you've heard many times, like Latin American debt, right? What does that mean? Well, these countries in Latin America, they sold bonds of their own country, promising to pay in 10 years, you know, X coupon, or 10 years or 20 years or 30 years or whatever. The period, the maturity varies, of course, okay? Now, the problem is that these governments, some of them didn't make good on their loans, okay, on their debts. And so the yield went up, okay? They became junk. Now, here's a key issue from an investment standpoint. Many times, and this insight was discovered by Michael Millikan in the 1970s. See, many times it's smart to buy a whole bunch of junk bonds in different industries, okay? A whole bunch of risky debt. And you say, well, why would I do that? You know, you're telling me that these companies are risky and that's why the yields are so high. Yeah, but see, if you buy a whole bunch of different kinds of junk bonds and you mix and match the right ones, what'll happen is that, see, some of those companies will fail and you won't get any of the money back or only a percentage of that money back. But see, the high interest, high yield of all the others will make up for it and you will still come out ahead. So far ahead that in many ways, it's better to invest in junk bonds than investment grade bonds. You'll make more money and it will actually be paradoxically safer. Now, that kind of very sophisticated investing, you have to be very, very careful. That's something that you need a quant guy. I mean, you need to be really smart, okay? And smart and experienced and know what the fuck you're doing, okay? An average newbie investor, that's like you're learning to ride a bike, and here I'm talking about rocket science, okay? So I'm just explaining it so you get a sense of where this is all going, okay? Now, these are the different kinds of bonds, corporate and government, investment grade, junk bonds, different kinds of government bonds, okay? Now, the government bonds in the United States, I'm going to talk about specifically the United States. Many times people talk about government bonds, government notes, and government paper, okay? Government bonds, government notes, government paper. They talk sometimes treasury bonds, treasury notes, and treasury paper. It's all the same thing. The only difference is maturity. Informally, you talk about treasury paper, it's usually under 90 days. Treasury notes under a year and over 90 days, but not really necessarily. And treasury bonds, everything over a year, 2 years, 5 years, 10 years, 20 years, 30 years, okay? But that's like really informal, okay? It's not like a hard and fast rule. Sometimes people talk about a 30-day treasury note, and they talk about it as a treasury bond that's 30 days, you know? I mean, it doesn't really, it's not a strict definition, okay? I'm just telling you so that you know, if you ever hear the word government bond or treasury bond, or excuse me, government note or government paper or treasury note or treasury page paper or agency paper, they talk about agency paper all the time. For some reason, when people talk about agency bonds, many times they refer to it as agency paper when it's like 20 or 30 years in maturity, okay? I don't know why, it's just usage, okay? But it's important that you understand that bonds, notes, paper, all the same thing, okay? Okay. And if you're not sure, just use the word bond. No, everybody's gonna understand you, okay? Don't worry. Now, the final asset class is, holy shit, I've been going on an hour and 40 minutes. Well, I hope that this is gonna be thorough, so I hope that it helps. Okay, so real estate. Real estate, essentially there are two kinds, residential and commercial. Commercial and also industrial. You could argue that industrial is kind of like commercial, but it doesn't matter. Now, the way you make money off of real estate is two ways. Either you buy it at one time and then sell it later at a higher price, or you buy it one time and just worry about bringing in the rental income, okay? Those are the two ways, trading and investment. That's the difference between the two, okay? Residential and commercial, I'm not going to dwell on it very much because it's pretty obvious, okay? And it's also very different for each market. For instance, there are some cities and countries where the residential property market, you buy the land itself, you buy the property forever in perpetuity, it's yours. But in some places, like in London, it's called a freehold, not a freehold, it's oh, the word slips my mind, I forgot it. It's basically a long-term lease. You're not actually buying the property, you're leasing it for like 99 years or something like that, okay? It's a weird system. And look, the point is, insofar as real estate is concerned, each category, each place rather, on the globe and within each category has its own specific rules, okay? You just have to know that it's just residential and commercial industrial, okay? That's all you need to know. Now, the big issue for newbies especially, how do you buy and sell assets? Well, quite simply, there is a broker for every asset. Insofar as real estate, how do you buy real estate? Oh, very simple. You go to a real estate agent, right? And she's usually some friendly lady who will show you around what properties are available if you're buying residential property, right? What's a real estate agent? A lady. What's a real estate agent? She's a broker. She puts buyers in touch with sellers. And that essentially is what happens in every single asset class. In every single asset class, there is a guy who puts buyers and sellers together. He's a middleman. And he takes a little cut, okay? Now, what happens is a lot of times for newbies, you become very intimidated because you don't know where to start, okay? So the easiest way to start is to go to your local bank and ask one of the executives there, hey, I have $10,000. How do I buy stocks? How to buy commodities? How do I buy bonds? You have to identify the broker in each asset class. Sometimes you will have a bank that will be one-stop shopping for everything. Citibank actually tried to do this, okay? It'll be like you go there and they will find the guy within that bank or within that financial institution that can set you up with corporate debt, set you up with with government debt, set you up with stocks or commodities or whatever the fuck you want to buy, okay? Sometimes you have to do a little more digging, okay? Each asset class will have the broker. And the thing that's key and what newbies don't understand often is that, see, each of these brokers, they have fees and they'll say, oh, these are our fees, but you can negotiate those fees and you should negotiate those fees, okay? And just tell them, look, you know, come on, give me a break on the fee here or I'll go someplace else. And usually they'll give you a price break, okay? You got to keep that in mind, see? Everything is negotiable, especially the broker fees. Because when they see somebody who's a newbie who doesn't know what the fuck he's doing, of course they're going to charge you an arm and a leg. They're probably going to charge you so much that even if you have a really great day trading, you're going to lose it all to the fees that you're going to pay for the broker, okay? So that's why you have to shop around and find the broker that is cheapest for your needs, okay? Because there's going to be a difference between somebody who's day trading and somebody who's just buying stuff for the long term, buy and hold strategy. A lot of people talk about a buy and hold strategy insofar as stocks or bonds or whatever the fuck, that is buying something and holding on to it long term, okay? But as I'll explain in just a moment, buy and hold is just investing, okay? It's not trading, but I'll get to that in just a second. The point I'm trying to make here is that, see, every asset has a broker. So you have to find the broker where you are, because I can't tell you like go to this guy or that guy, because in every place in the world it's a different guy, okay? It's a different system. Each city, each state, each country has their own system. And the quickest way to find out the system that you have is to go to your local bank and talk to somebody there and say, I want to invest in stocks, I want to invest in commodities, I want to invest in bonds, I want to invest in real estate, and ask them, who do I speak to? And that's how you start getting into it, okay? You start by going to your local bank, asking that you want, saying that you want to invest in whatever asset class, and asking them to put you in touch with the person who could help you out. If they can't help you out, ask them to point you in the right direction, and start investigating on your own. You got to get up off your ass and move your ass on your lonesome to find out where you're going to be able to do this, okay? Because it's not like they're advertising this shit, okay? They don't need to. You have to ask around. If you have a lawyer friend, okay, ask around. Ask any professional who is even marginally attached to the financial industries, okay? If you don't know, I'm assuming you don't know anything, okay? That you're completely ignorant, okay? What you do is you go to your local bank, the bank where you are banking, where you have an account, and you talk to somebody there and ask. And they'll be happy to tell you. Why will they be happy to tell you? Because a lot of times they are going to be charging you a fee. They're going to try to sell you a product whereby they get a fee from you, okay? And that's how you're going to learn. And so always what you do is you never say yes to anything until you've studied the whole thing really carefully, the whole environment really carefully. They will offer to sell you a product, say, for instance, a mutual fund that invests in commodities. That sounds great because you want to invest in commodities and you don't know shit about it. So let's say, oh, we can do it. We have a mutual fund or an ETF. An ETF is an exchange traded fund. It's basically like a fund that is on the stock market and trades as if it were a stock, but it's not a stock in a company, but rather a stock in a basket of commodities or other stocks or bonds or whatever the fuck, okay? They will try to sell you these products. And what you do is you say, very interesting. Can I learn more, please? And always, you never say no, you never say yes. You always say, can I learn more, please? Please explain more detail, more information. And that's how you learn. And eventually, by way of learning and talking to different people, you will find out what is the best way to buy and sell assets that you're interested in, i.e., which is the best broker for you insofar as getting into the buying and selling of whatever asset you're interested in. You see what I mean? Okay, so finally, what is trading? What is investing? Trading, as I said at the beginning, you are buying low and selling high. That's what it is. But see, a lot of times, the difference between the buy-in price and the sell price is going to be very low. Let me give you an example. Suppose you think that oil is going to go really high in price, okay? Like, okay, I'm making numbers up. Suppose you think it's going to go from $10 to $11, okay? And that's a price difference of 10%. That's a lot, right? But somehow you want to make more because if you buy, at $10 and sell it at 11, okay? You have to actually put $10 on the table and wait around to get 11, okay? And what happens if you want to goose it up? Little grasshopper. Then we go into options trading, okay? What are options trading? Options trading are the nuclear arms, the nuclear weapons of trading, okay? This is how it works. You can buy long or sell short, okay? That's essentially what it is. And everything else is just a variation of this. Okay, options trading. What is buy long? Suppose you think today that oil is worth $10, but you think that by the end of the month, by the 31st of May, it's going to be worth $11, right? You don't know when exactly it's going to go up, but you figure that by the 31st of May, it's going to be $11. It doesn't matter how you know this or believe this. That's not the point. The point is, see, you want to make money on that price differential, but you don't want to buy fucking $10 worth of oil today, wait around while you hold this fucking oil and then sell it for 11, right? You don't want the bother of having to hold on to the commodity. And at the same time, you want to maximize your return. You don't want to earn 10%. Suppose this is a sure thing, you're absolutely positive that it's going to go up by $1 between now and the end of the month. Well, then the way to maximize that, the multiplier effect, is to buy long, okay? Now, buying long basically means that, how could I put it? You are buying a Oh man, this is actually hard to explain, and I'm actually kind of tired because it's been close to 2 hours of this shit, and yeah, it's a little bit exhausting. But basically, it's a promise to pay something by a certain date. Okay, that's what you're doing. Um, let me do the reverse because it's actually easier. Selling short. Suppose you think that the price of oil today is $10 and it's going to go down to $9. Okay. So what you do is you sell it short. That is, you don't have any oil, but you go out and you sell a options contract, which is a promise. It's a contract, and you sell it to somebody and say, by the end of the month, I will deliver oil, and you pay me today $10. Okay, okay, and you do that, and you get $10. Somebody paid you $10, and you, what did you sell? You sold a promise that by the end of the month you would deliver that oil. Now, you don't think it's going to be worth $10 or $11. You think it's going to be less. And so you wait around, and by the end of the month, on the spot market, oil is trading at $9. And you got paid 10 on today, May 17th, right? So what happens is that you take $9, buy that oil, and give the oil to the person that you promised to deliver it on. Okay? That's short selling. Now, think how it works. I don't have anything when I take this guy's $10. I'm promising to pay him in the future. To pay him what? With money? No, with the commodity or the stock or the bond or whatever that that will happen in the future. I am shorting the market. Okay? I believe that the price will go lower. See? And so what I do is that I sell this contract, this short contract, and I'm promising to deliver by the end of the month the oil. Not the money, the oil, because he paid me the money. I have the money now. I have $10. And so what happens is that, see, I sell him, short sell, say 100,000 barrels worth of oil. And so what happens is that I'm fingers crossed that by the end of the month, oil will go down. What do I get right now? I get $1 million. Yeah, because right now the barrel of oil is worth $10. I actually don't know. I'm making this up, but bear with me. So I sold 100,000 barrels at $10 each. That's $1 million. I sold that, right? But of course, I don't have the oil. I sold it into the future. And by the end of the month, I will deliver that oil. Now, suppose that between now and May 31st, the price of oil starts going down. It goes down to, $8.50, and then, oh my God, excuse me, $9.50, and then, oh my God, $9, and then $8.50, and then $8, and then $7.50 by May 31st, right? I owe 100,000 barrels. I got $1 million for 100,000 barrels. But now, what's the price of 100,000 barrels? $750,000. What's the difference between $750,000 and $1 million? $250,000. I won $250,000. You see? You see how it works? That is short selling. Now, of course, here comes the terrifying part. See, suppose I sell 100,000 barrels worth of oil at $10 a pop, right? That's $1 million that I get. Now, a key issue, of course, is I don't get it right now. I get it on May 31st when the option expires. Okay, that's what it means. Okay, the day when the option contract that I have signed, it expires is the 31st of May. And we set it at a specific time, I don't know, noon Eastern, whatever the fuck, right? Okay, it expires at that time. I don't actually get on $1 million. I will get $1 million at that time, okay? Now here's the key issue. See, I sold this contract. I will get $1 million, but suppose the price of oil goes up. It goes from $10 to $11. That's a margin call. And see, a lot of these contracts, you who sell this, you have to put a guarantee that if the price of the commodity, the underlying commodity of the option goes up, you're covering it. There has to be a guarantee, okay? And if it breaks through that guarantee, if it keeps on climbing, suppose I put up $100,000 as a guarantee, okay? And I sold 100,000 barrels worth of oil at 10, but it goes to $10.75, i.e. $75,000 more. That's within my margin. I'm okay. But if it goes up to $11.10, that's beyond my margin. The fact of the matter is, the second it crosses $11 and goes to $11.01, I lose my margin. I'm wiped out. Okay? And sometimes you don't put a limit on your margin, you can be wiped out, like totally wiped out, because if the asset, goes to 11 bucks, 12 bucks, 13 bucks, 14 bucks, 15 bucks, right? And you're an unlimited option, all of a sudden, if it hits to $15, you owe $500,000. Yeah, you're fucked, you're screwed. You see how dangerous it is? Now, the flip side of this equation is buying long. Buying long means that you have the expectation that it'll go up in price. See, it's the flip side of the same contract. You see? And so that's options trading. Now, options trading, to make it very simple, and of course, get gamblers to the table, a lot of times you will have banks that will be your broker for options trading. And instead of doing the entire mechanics of this, they'll simply tell you, you have to put some money in an account as your margin account, and you can trade all you want, buy all the options you want, okay? And you just buy it with them, and you're trading with them. They become your counterparty. And this happens with investment banks, some commercial banks, depending on where you live, because some jurisdictions allow banks to do this, and some do not. And that's not important for this conversation. But the point is, see, options trading is the way that you can make money off the change in price of underlying assets. And the fact of the matter is, if you start looking into options trading, there are all kinds of strategies where you combine different forms of buying long and selling short. If you anticipate certain moves in the market and thereby lock in profitability, it can be extremely lucrative, but it's extremely complicated. You gotta be good at math. You gotta be very fast on your feet, and you gotta be very, very careful, because a lot of times this shit moves so fast that you can get wiped out without even knowing it. Okay. Options trading is, like I said, like the nuclear weapon of trading. It's buy low, selling high. Yeah, that's the basics of trading. But options trading, that's trading on steroids. That's very, very risky, very dangerous. A lot of people have been wiped out. A lot of people have jumped out of windows because of their options trading going the wrong way. You don't want to fuck around with that shit, okay? I fucked around on it on a time or two, and it never ended well for me, okay? And to the point that at this point in my life, I haven't traded in options. Well, that's not true. I was actually involved in an options deal just now. And yeah, and I traded in some options, yeah, but they were naked shorts, okay? A naked short is when you think that something is just gonna go down and you don't do anything clever, okay? So yeah, what the fuck am I talking about, man? I'm full of shit. It's like a heroin junkie saying, yeah, no, I haven't done smack since Jesus, years ago, since like last week. Yeah, god damn, that's embarrassing on my part. But anyway, that's trading. Okay, trading is you hop on and hop off. A lot of people ask, what is day trading? Okay, and should I day trade? Day trading can be very lucrative, and the most effective strategy in day trading is not options trading. Okay, a lot of day traders do options trading, which I think is stupid. A lot of the best day trading I ever did was totally momentum trading. And what is momentum trading? Is when you hear from other traders, other people who are doing the same shit you are, that XYZ stock is hot, and you hop on, hop off. Okay, you don't even give a shit what the company is. There was a period of time in 99, 2000 when I was day trading kind of like obsessively, and I'd say for maybe 60, 75% of the time, I had no idea what I was trading. I just traded the letters, and especially in penny stock. Penny stock are low capital stock companies that are very small, and so their stock is often trades in the penny range. It's not even a dollar. Okay, that's part of the reason that Citibank was so nervous about having its share price being close to $5. They wanted to differentiate themselves from penny stocks, right? Small companies, you know, like that have sales in like the 10 to $50 million range per year. Sales, gross revenue of the 10 to $50 million a year, they're penny stock, okay? And for whatever reason that they're in some small market, some small stock market, and these penny stock, right? A lot of times people will hop on and hop off, and they'll be like momentum trades, and they're very dangerous, you know, and they just wreak havoc, and they're no social utility except for, you know, making a bit of money. And I was involved in that in the 99, 2000. And in momentum trading, you get plugged in to forums, you get plugged into email threads and different chat rooms and whatnot, and you talk about what's hot, and you hop onto that stock having no idea what it is, and it goes up a little or goes down a little, what as the case may be, and then you hop off and you count your winnings, or you just, you know, lick your wounds kind of thing. Momentum trading is like the worst, okay? And high frequency trading, just to round off the topic, this is basically computers trading at a very rapid pace. I mean, thousands of trades per second. And they are looking for the infinitesimal price difference. I'm talking fractions of a penny per trade. And that adds up, okay? And that's just basically, it's basically computer scientists fucking around with computers. I mean, one could argue it's not even trading, it's just like robots gambling, okay? That's, you know, not interesting. And finally, okay, what is investing? Investing is, well, trading is gambling, okay? That's what it is. No matter how you look at it, you have a notion that today the market is at a certain point. The asset, whatsoever that asset may be, is at a certain price point. And tomorrow it will be better for you, okay? Because it could be like, for instance, when you're selling short some stock, today it might be 100 and you're hoping that tomorrow will be 90, okay? So ultimately trading, what you're talking about when you talk about trading is not that the thing rises in value, but rather it changes in value in a way that will be beneficial to you. That's what trading is, okay? The notion that it's only buy low and sell high, that's the only way to trade, that's not accurate. You can make money by options, and look into options if you're interested in that, of how to make money with a falling market, okay? Well, anyway, options trading is the way to go. Trading is making money off the price differential. Now, this is actually important because you'll notice that a differential, what's key insofar as differential is concerned, or what discipline, academic discipline, depends on price, on differentials. Calculus. Yeah. Calculus is what you need to know if you really want to get good at options trading, okay? I mean, I'm pointing you in the direction. You learn calculus, you learn it real well, you can fuck around with options trading and make a lot of money. But you got to know what you're doing, because the guys that you'd be trading against, they know what they're doing. Those guys, most of them are fucking PhDs, you know, in all kinds of high-level math. That's why they got hired, okay? It's understand that. Anyway, trading is gambling. Investing is not gambling. Investing is it's the way to earn money off of capital, and you don't have to work yourself. That's what investing is. You are buying income streams, or you are accumulating the capital that will provide you income streams. You never want to be trading, or let me phrase that. I personally think that trading should be done very carefully and very specifically. I can tell you the last 6 months, I was involved in 2 trades, okay? I'm not gonna tell you the specifics, but the generalities. Number 1, I worked with a group of people, investors, who identified some bonds that were severely mispriced. These were okay, they were corporate bonds, but they were corporate debt owned by a sovereign nation. So it's kind of vague as to whether it was really sovereign debt or corporate debt. So let's just call it corporate debt for the sake of argument. We noticed that they were severely mispriced for perfectly legitimate reasons. It wasn't like insider information or any shit like that. And so we put together a fund with several investors, and we got into these bonds in a big way. And I was part of that. I was one of the investors. I was one of the small fry in it. And we went into these bonds and we executed a very sophisticated option strategy that, to tell you the honest truth, I did not quite understand myself. Okay. And I consider myself a fairly smart guy. But hello, do you hear me? There seems to have been a slight problem with my audio. Let me just check real quick the audio. Raise your hand if you can hear me properly, please. I'm so sorry because I fucked around with something and okay, great. Okay, so anyway, I was involved in this group and they went ahead and executed this very sophisticated option strategy, which I myself, frankly, could not explain to you without a piece of paper and a lot of drawings. I was not clear about it in part of the elements, but I was with people who, number one, were investing shit ton more money than I was, number one, and number two, they were guys I'd known for a decade and a half. I trusted them completely. And they were telling me, look, you'll be fine, just shut up and just do what we tell you to do. And I was involved in client relationships. I was basically helping out with these guys who set up this fund to manage the other investors in this fund. And long story short, I wound up with basically improving my net worth by about 36%. Okay. It was a very, very successful business. I have no real idea how exactly it happened, but it did happen and everything was wonderful and nothing hurts. On the contrary. But that was sophisticated options trading, and I hesitate to tell you exactly how it was done, but it was done and I saw the checks and the check cleared in my bank account, so I'm good, okay? The other options trading that I personally did in the last 6 months was actually because of coronavirus. In late January, when this thing popped up, I thought to myself, man, this is gonna wreak havoc with the supply chains. And I was thinking, Apple, Samsung, and some other companies that would be affected. I thought, this is going to hurt the NASDAQ. So I bought some shorts and I made a shit ton of money. Simple as that. They were basically 60 days, 90 days, and 120 days. And they were so successful because of the collapse and especially the perfect market timing in mid-March when everything was just going down the tubes, that my counterparties, the banks by which I bought these shorts, they were like, we'll buy them off you. Because they were so concerned about their exposure that they decided that it would be better for them to just, because they didn't know what was going to happen, if the markets were going to continue to fall. And so they said, we'll buy them off you right now, the whole shebang. And I sold them, and I sold them again for quite a bit of money. But again, that was a naked short. I knew exactly what I was doing. I knew exactly what my aim was. My thinking was the whole thing is going to fall hard because of the interruptions in the supply chains. And for that, I had to put up, I'm not going to tell you exactly how much money I had to put up. I had to put up a lot of money, of my own money, for these shorts in case the market continued to rise after I bought them. And they did. The market did. And I actually came close to losing that margin that I put up, even though I had the right bet. Even though I had the right bet long term, the market kept on going up to the point where my margin was shrinking. And I was at the point where I might lose the margin and lose the options, okay? And I was sweating bullets for a while. I'm not gonna lie to you. Yeah, you guys remember the time, right around the time I broke my ankle, right, in February? Yeah, like when I got back from that trip, before the whole shit house went up in flames, in late February, around my birthday, I was really, really depressed because I was coming really close to eating up my margin. But then then things turned around, i.e. they went south and I made a shit ton of money. Okay, I mean, I made a lot of fucking money. Again, I'm not gonna tell you how much, but it was very, very good. And those were the two options bets that I made, and they were high risk, and that's the point. In the business I was involved in with these other investors, they were big fry and they were very sophisticated and they knew more or less what they were doing. And I was with a bunch of guys that I'd known a long time and they were going to take care of me. But still, my fate, my destiny was in the hands of other guys. And I respect them and like them. But still, I was risking in this deal, I risked approximately, I'd say about 12% of my net worth on this one deal. And there was a possibility of it coming out like it did, but there was also the possibility that I could have lost that 12% of my net worth, which would have hurt a lot, no question. And on the other side of the equation, on this other bet that I made on my own, right, there was also the possibility of losing, that was about 4.5 to almost 5% of my net worth, which is still a lot of money, you know, and it would have hurt, fucking A, it would have hurt, okay? That one came out a cropper. That was actually better because I made close to 20% off of that bet. Okay, so those were two really good bets, but you got to keep in mind, on the one hand, I was putting my fate in the hands of other people, more sophisticated traders and guys I knew, but still other people were controlling the situation. And on the one hand, and on the other hand, I nearly got wiped out. Instead of winding up 20 percentage points ahead, I could have wound up close to 5 percentage points down, okay? And that came awfully close to happening. So you have to understand that this kind of deal of options, they are very, very dangerous. Would I do it again? I'm not gonna fucking do it again for at least a couple of years, at least, if not more. And probably in a couple of years or 5 years, when I get over this scare that I had, because I was scared shitless, I'll think to myself, you know, maybe it's not worth it. And that's the key issue. Is the risk worth the reward? That's the issue with trading, okay? Is the risk worth the reward? You get to a certain age, as I am, and you have a certain set of responsibilities. You got to keep in mind, I look after several people in my life, okay? And so because of that, they depend on me. And they depend on me, and not only that, when I'm dead, they're still going to be depending on me, okay? So I have to make sure that, you know, I don't ever get wiped out between now and the day that I die. And even after I die, I have to set it up so that they can depend on this income, this money that I can provide for them. And that's why I only invest. And looking at the situation now, I'm not going to be doing anything other than investing, i.e. buying income streams, because income is what you need. A company goes broke when it doesn't have income, okay? A company that has income, that has a healthy income stream, even if it's loaded with debt, even if it has to make all these payments of interest and depreciation, amortization, and taxes, and whatnot, if it has a healthy income stream, it will survive. If a company does not have income, it will die. It will go bankrupt. That's the definition of bankruptcy. It's a lack of income to cover your expenses, okay? That's what bankruptcy is, okay? And so you have to always be thinking to yourself that you want to be having an income stream, okay? You want to be buying it. But the problem is that, see, in order to buy an income stream, you need capital. So how do you get that capital? You have to trade. You have to start by trading. That's the conundrum, okay? You have to be very careful about this kind of shit. You can lose a lot. It's very tempting to make the big bet, to say, oh, this is a sure thing. And that's where you get screwed. In trading, you should never bet more than 10%, okay? I said before that I bet kind of like more than that, but I was fairly confident, especially because I was involved with these guys that not only had I known them for a long time, but the fact of the matter is that a lot of my net worth had been because of my association with these guys. And so I knew that they weren't going to fuck me over. They're not guys out to, like, you know, rob me or scam me out of money. Okay, I mean, quite frankly, I'm small fry to these guys. Okay, and precisely because I was small fry, I knew I could trust them. See, that's the thing. You can only trust people when you know that they don't need you. Okay, so anyway, I've gone talking about this shit for 2.25 hours. Okay, you guys must be sick of me. So let me just throw the whole thing open. Hang on a second. There's one guy who has wanted to talk to me. Wait one moment. Okay, hang on a second, because there's a guy whose name's still in mind, and stupidly, I thought to myself, I'm going to write down his name so I don't forget, but I forgot to write down his name. So let me just look him up here. Wait up, wait up, wait up. Etem, yes. Etem, let me find Etem, there we go. Yeah, Etem Yildiz wanted to ask me a question, and I'm happy to answer it. Etem, how's it going?
Hi, do you hear me?
Yeah, I hear you fine. What's up?
Yeah, good. I'm good. I'm in San Francisco.
How can I help you?
Yeah, so it's I've been following you like almost 1 year. It's I really enjoy your content. So
I'm
thank you
so
for
glad. Thank you.
Yeah. But my question is not about the economy. It's kind of about politics.
Mhm.
So it's in North Syria. It's Kurds right now building a secular value after they kicked the ISIS from that area. So
Yeah.
are you aware of that? So what do you think? What do you think?
Not really. I don't know enough information to give an intelligent opinion, to tell you the truth. I mean, I wish I did, but I just don't follow that right now, to tell you the truth. What with coronavirus and all the rest of it, I am not following it. I'm sorry.
Okay. Thank you for having me. Thank you for giving me a chance.
Oh, no. Do you have any other question about the topic that I've been discussing?
It's actually one more small question. I don't want to like take a long time.
Sure.
Other
No, that's quite all right. Please.
Yeah, it's a lot of conspiracy theory going on about Bill Gates that behind the coronavirus. What do you think about that? Also, I would sometimes want to ask you that question also.
I don't think that Bill Gates is behind the coronavirus per se. I think that he is perhaps helped to make the panic a little greater because he has an agenda. I do not trust his agenda at all. I think that he wants to control people. He wants to have this immunity certificate system in place so that people either have to buy his testing kit to prove that they are that they have the coronavirus antibodies, or pay for his vaccine to be cured of the coronavirus. I think that he's a shady guy. I don't like him. And yeah, that's what I think. Do I think that he caused this? No. Do I think that he has exacerbated the problem and that he has pressured government officials in both the United Kingdom and the United States to lock down the economy and crash the economy for the sake of this coronavirus? Yes. I think that he is a pernicious influence. I think that retrospectively people will look back on him with scorn. That's what I think. Yeah.
Because he's like 2015 he did like a presentation, and it's like very close to imagine that virus that kind of close. It's kind of like people also worry about, and he also doing some vaccine work.
There will never be a vaccine. Okay, there
Yeah.
will never be a vaccine. They haven't come up with a vaccine for HIV in 40 years. So do you honestly think that they're going to come up with a vaccine for this coronavirus? No, I don't think so. Okay. So, it's shady, and we're at the end stages of neoliberal democratic system that is so corrupt. That's the problem. The corruption and the dishonesty is just so great that we can't trust anybody. I certainly don't trust Bill Gates. That's my thinking. Yeah. Does that answer your question, Itam?
Yeah, pretty much. Yeah, it's like
Great.
okay.
Great talking to you. Great
Okay.
talking.
Yeah.
Talk to you soon. Okay, so who else has a question? Raise your hand if you have any question. Let me try Ryan H. Ryan H, how's it going? You there?
Hey, I'm good. How are you?
Pretty good, pretty good. What's up?
Yeah, so I have a question about the bonds. This has been a real clarity for me so far, so thank you for that.
Oh, it's my pleasure. I'm so glad.
So if you buy bonds, you said that there's coupons that come with that bond. Why can't like if I go on to like my Schwab account or something like that, if I buy a bond or something, where would I go to like renew those coupons that you were talking about?
Oh, yeah, no. In today's system, it's sort of like automatic. You don't have to worry about it. Okay.
Okay, yeah, that makes sense.
Yeah, and that it was in the past when there weren't computers to do all this stuff. Okay.
So
But
it's kind
you
of
should,
built into the price.
yeah. A lot of
Okay.
times it's built into the price, but you have to look at look at each trading platform. I don't have Charles Schwab platform or any platform for that matter. I do it all retail with a banker that I have. But you see, they're not trying to cheat you or anything. You're not going to be missing out on anything. Okay.
Right.
And so don't worry about that. The system is very robust in that regard. Okay. And the reason it's robust is not because everybody is so honest, but because they realize that if there were ever any problem with anybody, it would cause such a panic so quickly that it would destroy their business. So it's in their best interests to be as honest and transparent as possible. Okay. That doesn't mean that you should just, take them at their word. Always double check their numbers, even their addition. But don't get paranoid, okay? If things seem to be on the up and up, then they likely are on the up and up, not because they're afraid of regulators, but because they're afraid of destroying their business via bad reputation. Because they all are very aware of how quickly a bad reputation spread online can destroy a business, okay?
Yeah, it makes sense. I was just curious because, yeah, I've always known about bonds, but this, has brought more clarity over time. And I've learned about it before, but this really helps. So I know it seemed kind of boring, might seem boring for some people, but I thought it was really interesting. So appreciate it.
Hey, my pleasure. Thank you so much. Yeah, I mean, I was worried about that, whether people would find it like boring, but well, you all are still here. Either you're still here and you think it's interesting, or you're still here because some enormous piece of furniture has fallen on top of you and you can't turn off your computer. One or two possibilities. So I'll go with the former. Okay, so Lucas Hojensky, I hope I'm pronouncing that correct.
Yeah,
Lucas, are you
yeah.
there?
Yes, coach. Do you hear me?
Yes, I hear you fine. What's up?
Thank you. Coach, I'm from Poland, and like a couple weeks ago, I heard a rumor that in 2 to 4 years in Ukraine, they will gonna sell the land for foreigners as well. Did you hear anything about that? I mean, agricultural land.
I have no idea. I could
You
not
have
tell
no
you.
idea.
No.
Okay, okay.
Yeah.
And the second short question is, well, I'm in dentistry business,
Hmm.
and there is more and more everywhere.
Hang on, Lucas. Lucas, can
Yeah,
I go back a little bit?
yeah, yeah,
If
yeah, yeah.
about the question about buying land in Ukraine, okay? See, I would not buy land in Ukraine because as a foreigner, I think that I'd be more likely that they would steal it somehow. Okay?
Got it.
And this is something that you should always consider insofar as getting into any asset class, whether the people there can somehow steal it from you or take it away from you. Now, in some commodities, that's a ridiculous, in some asset classes rather, it's a ridiculous concern. For instance, like Ryan before was talking about, he has some Schwab account that buys and sells stocks and bonds and whatnot. Schwab is never going to steal anybody from anything. Okay, it's not in their interest. It would be a disaster for their business. They're not going to do it. But for instance, if you were to buy real estate in Ukraine as a foreigner, you might get cheated out of it because it's in Cyrillic. The contracts are in Cyrillic, and if you don't speak Russian and read Russian, if you don't know all the legal ins and outs, they could slip a fast one by you and wind up stealing what you have. So you see, so you have
Got
to
it.
always be aware of that. Just because some investment opportunity seems incredibly lucrative doesn't mean that it's a safe investment. You always have to think that in any situation, the rule of law is only as solid as or let me rephrase it. See, you can lose out, you can get cheated out of something easily unless there are other factors protecting the rule of law. You
Got it.
see? And a
Yeah,
foreigner in a place like Ukraine, and I lived in Ukraine, right? But I would never buy land in Ukraine under my own name. No way, because my name is clearly foreign name. I don't read the language. I don't know anything. I'd get fucked over. So I'd never do that. I have purchased land, but it's in the name of other people, local people. And so, yeah, it's a different thing. And it's also for long-term planning because I have children who are Ukrainian citizens and they're going to eventually inherit this. So no worries in that regard. I mean, but if you're just a foreigner as an investment opportunity, I'd be very, very scared. That's just my opinion. So anyway,
Got
what
it.
was your second question? I cut you off.
Well, short second question is, could you give me an advice about the balance between creating my own company? Like I said, it's a dentistry business, but I just started, and level of living, if you know what I mean, how much to invest in myself and my business, and how much I supposed to live to myself. And just to be quite honest with you, I don't have family yet, so you know what I mean.
Well,
Yeah.
then at this point in time, you want to minimize your living expenses and put it all into your dentistry business, of course. What other option is there? See? I mean,
Got it.
I mean, look, if you're serious about starting any business, right, then that business will be your life. And your regular life, well, why are you blowing money on? Blowing money on an expensive apartment or on parties or booze or whatever, I mean, if you're serious about your business, live like a monk and spend all your days at your business. Your apartment is where you sleep and that's it, you know? That's how it should be. And I'm not saying it like on some sort of moral ground, but because that way you're just focusing all of your attention on your business and not allowing other things that are not that important to interfere and distract you. Okay. You're talking about a dentistry business. Are you thinking of bringing on other dentists so that they work and you like provide the place for them to work, that kind of thing?
Well, I'm a dentist, but I also thinking just like you said, yeah, to put other doctors in a work in my places, but in the future. Thank you, coach. Thank you.
Yeah.
Thank you.
Yeah. No
Yep.
problem. Hope that helps. Great talking to you, Lucas. Let me see who else. Yeah, I see you guys, Patrick and Mr. Blue, but I want to call on new names. I don't think I've spoken to Adam Edwards. Have I spoken to you before? Adam, are you there? Hello, Adam. Adam, are you there? Oh, guys, remember, plug in and configure your mic. I'm happy to talk to you guys. I love talking to you guys, but you gotta help me out here with your mic. Alvaro Barrera, are you there? Alvaro, hello. Hello. Oh man, we're going 2 for 2. Alvaro.
Can you hear me,
Hello.
Coach?
Yeah, what's up? How's it going?
Hi, Coach. How are you doing? Nice to meet you. It's a
Nice
pleasure.
talking to you too. What's up?
Yes, all good here. My question is, what is your thoughts on index funds? You see, I'm investing like 50% of my wages on invest funds, and also paying my mortgage. I've got a mortgage in Colombia, and I'm basically living in a rent here in London. But the way I'm saving for my future is index funds. Looking forward for probably investing in mutual funds in a few months. But it was your thought on index funds.
Well, I don't have a problem with any fund at all, for whatever the fund might be, okay? Just so long as whoever is running it is solid, okay? Now, why am I saying that? Well, because we're about to experience we're about to experience a drop in the stock market, okay? Because for the past 2 months, ever since the bottom, in mid-March, the central banks and the Treasury Department in the United States, at least, have been going out of their way to prop up the markets, right? I'm pulling up the markets right now just to see where they're at because I haven't been following them. And the reason I haven't been following them is because they're full of shit, okay? Okay, so I'm looking at the Dow Jones. It's sort of like stabilized at around 23.5 to 24,000, right? Well, 23.5 to 24.5. This is unreal, okay? And because all these companies, none of them are making any revenue, okay? And so my concern of being invested in the stock market right now, and also in bonds for that matter, is that we are in a depression. We have to face that fact. We have to face the fact that all these companies, in order to survive, will have to shrink noticeably because consumers are not going to come back. When the economy reopens, whenever that may be, and there are so many politicians who are trying to have the economy not reopen, right? But see, these companies are never going to go back to the way they were. They're never going to have the revenue that they used to have, let alone the net income. So the stock market prices, which before were inflated astronomically, they're still inflated, okay? And people just are not accepting reality. And so because of it, right now we're in this weird phase where things are up in the air, right? Insofar as prices are concerned, but they don't reflect reality. In the United States, there are 33 million unemployed people. Reputable people are saying, and I could not fucking believe it when I read this, but they are saying that the GDP will contract by 40%, okay? The GDP will contract by 40%, and that seems unreal until you start to realize that these aren't crazy people. People are looking at the data. Everything is closed, everything is shut down, nothing is really working, okay? And so the investment opportunities, the problem is going to be that, see, there aren't going to be investment opportunities for things going up in value. And if you think to yourself that you can sell short and make money off the fall, well, yes, but so long as your counterparty, the person that you're betting against, makes good on their bet. Because what happens if the bank that you took out the option with goes bust and they don't make good on their bet? Yeah, you made the right bet, but you didn't make any money, you see? And so what you're talking about really by asking me about index funds is, you know, what's a good thing to invest in right now? I cannot tell you this. I can tell you what I am doing. I am cash, all cash. Okay. I have at this time, I can tell you exactly what I have. I have a real estate portfolio that's doing well, thank God. The tenants and all the properties that we have are doing fine, you know, and for reasons I know that they will continue to do fine. But it wasn't because I was so smart. It was rather because I was so lucky. Because I do have some commercial real estate, but the businesses that occupy that commercial real estate, they will continue to prosper. However, I do believe that they will, in the not too distant future, they will come at me and want to renegotiate the price, renegotiate it down, because once this is over and all these offices are empty, they're going to realize that they can negotiate a lower price and they'll get it from me, and I'll have to reduce the rental price because there's going to be so much available inventory for office space that these guys could close out the contract with me and move elsewhere. And so I'll probably have to market down my property by my rental by 30 to 40%, and I'll consider myself lucky if I do better than 50%. If I have to reduce rent but still stay above the current 50%, if currently 50% of what it is currently. You see what I'm saying? So we're going into depression, okay? And we got to face that fact. And so any kind of stock market or bond market or commodity, it's crazy at this time. But that's me. I can't tell you what to do, okay? I can't tell you that. I mean, because it would be illegal in some jurisdictions. And on the other hand, you know, each person has to take responsibility for their own decisions. And I don't want to be the person shouldering the responsibility for other people's decisions, whether they be good or bad. But it's up to each of you. I'm telling you what I'm doing. I personally am all cash, except for my real estate portfolio that I'm not going to sell, because I know that if I tried to sell any of the assets in my real estate portfolio, I would not get the best price because there are simply no buyers. And I do not anticipate there being any buyers in real estate for at least 5 years. Okay. And so the smart thing for me is to just be cash, stay in cash, and wait to see what's going to happen and keep my eyes on inflation indices. Because the only thing that can hurt my cash position is hyperinflation or runaway inflation. And so that's the only thing I'm keeping an eye on. Other than that, I personally do not see anything that I would feel comfortable investing in. The only thing I could maybe be convinced into investing in would be property if it's severely discounted from the previous levels, that is the 2019 levels. If there were property on sale at say 50% of the market value in 2019, I'd get on it, maybe. But then I'd be thinking also, if they're selling it for 50% of what it was in 2019, then they can't even rent this fucking thing, or they can rent it for peanuts, and therefore it's still not a good buy. You see what I'm saying? I mean,
Yes.
you always want to be thinking of what's the motivation of the seller. Okay. If you know right away that the seller wants cash because he wants to sell his house because he's moving away to some other city because he got a good job there, okay, that's the motivation, fine. And then, usually it's like that. But in these times, you want to be looking at the motivation of people, especially when there is a deal that's too good to be true. If there's a deal that's too good to be true, if some, $1 million house is being sold for $100,000, you got to start digging and figure out why. You got to figure out why. You see what I'm saying? Yeah.
Yes.
Okay. I hope this helps,
Yes.
Alvaro.
Yes, this definitely helped. I think I'll take your advice because I've got 2 years left on my mortgage, so I think I'm just going to finish that and keep it, since it's kind of like a not safe bet, but it's a good option. Thank you very much, Coach. Thank you for the time.
No problem. Thank you so much, Alvaro. Talk to you next week.
Thank you for.
Oops. Oh, I'm sorry, Alvaro. Man, I cut you off. Hang on a second. Let me unmute Alvaro again. Alvaro, are you there? I cut you off. I'm so sorry.
Yeah, I'm here. I'm here. Yes. No, don't worry.
What were you saying?
I'm saying thank you for the webinar, and I've been enjoying all your videos. It's like a everyday thing. So thank you very much, Coach, for your advices.
Okay.
Thank you.
Thank you. Oh man, I thought I'd cut off Alvaro in the middle of him saying something. I felt like an asshole. Sorry about that. So anyway, Humphrey Chen. I don't think I've ever spoken to Humphrey Chen. Are you there, Humphrey?
Hello, can you hear me?
Yeah, I hear you fine. What's up?
Great. First, I'd like to apologize for last week. You called my name and I wasn't around.
Oh,
I
don't
was
worry
on
about it.
another conference. Yeah, sorry about that.
Don't worry about it.
Yeah, I have a question about the real estate investment. About 2017 to 2019, I have had this peer pressure to get a property somewhere because I left my native country like 19 years ago, and my peers, they all have all their mortgages and property. But during that time, when I look at the global index for real estate, I think that it was overpriced, and I decided not to go into the market. I'm glad I didn't go into the market because of the peer pressure. And my question is, first question is, do you think it's cheaper to actually rent than buy your own place if you want to stay in that place? That's the first question. The second question is, what is the guideline, or what is the kind of percentage you are looking at before you decide the place to actually buy the property for residential? Is for your own stay? That's the second question. Yeah.
Okay. Whether to buy or rent, that's the eternal question. I personally find it better to rent where I live, even though I purchase real estate in that very market, because it gives you flexibility. And as simple as that. See, when you buy a property, it's yours, okay? And if the market is not particularly liquid, then you're going to be stuck with it, okay? So sometimes it might be just better to rent. It gives you more flexibility, especially when the return on investment insofar as properties is so low rather, okay? I mean, think of it in these terms. See, suppose you're in a market where the return on the investment, the rental value versus the price is like 4%, right? So 4%, to put that, to to numbers here. Let me break out the calculator real quick just to do this real fast. If if we're saying 4%, suppose you're paying I don't know, $1,200, $1,500 a month times 12 is $18,000 a year, divided by 0.04. Right. So you're talking about parking $450,000 into some property. That would be the cost of it, but you can rent it for $18,000 a year. Wouldn't that be better to rent it and you can free up that cash to do other stuff? And you say to yourself, well, you're gonna take out a mortgage to buy that place, but still, you know, you're gonna it might be just easier. I don't know. I mean, it's an internal conundrum. In very hot markets, very liquid markets, like for instance in Los Angeles, in New York, maybe it's better to buy. You take out a mortgage, and instead of like throwing away the money on rent, you're putting the money away into the mortgage. And as soon as you turn around to sell the property, boom, you've got 10 buyers crop up. Because in those hot markets like LA and New York, sure, you've got that situation. But what happens if you're in a slower market? Okay, then it's more complicated, right? I personally don't have a problem renting. Okay, sometimes just for the flexibility. For instance, well, here I'm stuck in Amsterdam, but there was a specific situation because I knew I was going to be here only for a year to 18 months because of this deal I was telling you about, right? And so, yeah, the idea of buying a place just was not really appealing, and so just rent it, and that's fine. But in a more liquid market, then yeah, it would have been better to buy. It depends on the market, simple, on a whole bunch of factors. Now, the issue becomes another part that you were asking is that you were getting a lot of peer pressure to buy property. Smart that you resisted, you know, because if you saw it was overpriced, then it's overpriced. The notion of when to buy or when to sell, it's real easy. It's when everybody is talking about it, either for good or ill. That's when you do the opposite. Okay, like back in 2018, I think it was, everybody was talking about Bitcoin. I mean, I was watching Philip DeFranco, and even on Philip DeFranco, they were talking about Bitcoin. Now, I personally didn't own any Bitcoin, right? But if I had owned Bitcoin, I would have known that that's the time to sell, okay? When everybody's talking about it and saying it's so wonderful, that's when you sell. When everybody's saying that the sky is falling, it's the end of the world, that's when you buy, okay? It's real simple. The Baron de Rothschild in the 1800s said, buy when there's blood on the streets. Absolutely right. When everybody's saying that it's all shit and everything's a disaster and we're all gonna die, then you go out there and buy with both fists, you know? Just chuck money out the window and buy. When everybody's saying that now is the time to sell, okay? When everybody's saying that the sky is falling, the earth is going to crash into the sun, you know, and everything is going tits up, that's when you buy. And so I guess what I'm basically going to be doing is I'm going to wait, and I'm thinking within like a year to perhaps 2 years, when the economic situation is really bad and everybody's really freaking out, and they're talking about how prices are collapsing, the housing prices, and you know, apartments in New York are selling for, you know, 1,000 square foot apartments are selling for $100,000 or some shit like that, which will happen eventually. When that moment happens, that's when I'm going to buy. That's me personally. Okay. Yeah. I hope this answers your question.
Yeah, thank you very much. Yeah, and can I ask one more question? Do you have
Sure.
time? Yeah.
Yeah, of course.
Which European city do you think is the best to buy a real estate for living or for investment? I mean, based on your experience living in Europe, in different cities in Europe. Yeah, just want to ask you that question. Yeah.
That's a good question, but it depends on a lot of factors. Okay. Let me explain. First of all, number one, it's hard to tell which cities are going to do well into the future. I personally think that Amsterdam is going to do very well, and Holland in general, because a lot of British companies are going to move out here to Holland because of Brexit, so that they can have European offices within the European Union. And this would mean that a lot of British people would come here to Holland. And Holland has always been like a focal point. And also, Holland is the one country that didn't lose their shit over coronavirus. and they had their house very, very tidy, very organized. And so the damage here in Holland is minimal compared to other countries. Forget about the United States, okay? This whole shutdown has not been a big deal in Holland. There haven't been a lot of bankruptcies, and there won't be a lot of bankruptcies, because the Dutch, when they had a surplus, a budget surplus, they set it aside. They set aside something like $14 billion for, you know, for a rainy day. And so when the rainy day came, they were fine. They are fine. A lot of small businesses are going to be doing fine, and you know, that's that. But in Europe, I would say that Amsterdam is a pretty good investment. But the thing is, see, Amsterdam prices are stable. Real estate prices are stable. They're not going to be going down because, like I said, the crisis didn't hit that hard. You would want to go to a city where the real estate prices took a huge hit, but long term, it's such an important city that it'll come back, and therefore it's smart to invest in it. Because if you want to maximize your return on investment, right? The amount of money that you would receive from a property, from the dollar that you invest in the property, then you want to reduce the price of that investment before you get into it, right? And you'd want to go therefore to a city that is going to take a huge hit but recover. That is, it's going to be like a deep V, like it falls and then eventually it slowly comes back up. Because in Holland, what's happened is that it sort of like dipped slightly and then kept on going. Okay, because I know that prices in Holland are pretty stable, at least in Amsterdam, and I would venture to guess throughout the rest of Holland as well. It's been pretty stable, and I don't think that it's going to fall. Whereas in the United States, we're starting to already see price weakness in a lot of homes, especially residential properties, because people are missing their mortgage payments because they're out of a job or their business went tits up and they need to sell. Yeah, that's when we're going to start to see real damage in the housing market in the U.S. We're going to start to see that in the third and fourth quarter of this year. That's when things are really going to get bad, because when things start to revamp and come back online again, that's when the real damage is going to be evident. Okay, so this is a very long answer to your very simple question. You're asking, what's the best city in Europe to invest in? Well, do you want the biggest bang for your buck? You're going to have to look around to the different cities and the different places in Europe to see which is taking the biggest hit but will recover. If you're looking for the most stable, I would say Holland. But it's a different priorities that you would have, that you have to decide for yourself what's more important to you. You see what I'm saying?
Yeah. Thank you very much. Thank you.
No problem.
Yeah.
Pleasure talking to you, man. Okay, John Connor. Oh my goodness. John Connor, I'm not gonna make any joke about the Terminator. You there, John?
Yes. Hi.
Hi, how's it going?
Here.
What's
Good.
up?
Yes, you mentioned a week ago about buying what Fed is buying, and I am wondering if there is, I don't know, how do you know what Fed is buying?
What the Fed is buying. Okay,
Yeah.
okay, yeah. Okay, the Federal Reserve, there's a saying in Wall Street, which is follow what the Fed is doing, don't fight the Fed. There's some like clipping noise, so I'm going to mute you because it's coming from your microphone, John. So hang on, I'll mute you now, but then later, after I've answered your question, I'll unmute you so you can do any follow-up. The follow the Fed is an expression in Wall Street, which is basically, see, when the Federal Reserve starts to make moves in the open markets, don't bet against the Fed, because the Fed is just bigger than you. Whatever the Fed is going to be buying, don't buy against it. Don't bet against it. Buy what the Fed is buying, okay? Now, insofar as retail investors, small investors, somebody new, right? You would basically read news sources that tell you what the Fed is buying, purchasing, insofar as asset classes, and you would know that those asset classes are going to be price defended by the Federal Reserve. If you're a newbie investor, to be honest and not to sound like a jerk, it's not really relevant to you. Don't worry about it. It's more for people who are more sophisticated and more experienced and can react quickly. Because if you, as an experienced investor, realize that the Fed is about to purchase, say, some ETF for whatever reason, then you're going to get into that ETF in a big way before the Fed makes its move. Or you can start anticipating what the Fed is going to be doing. If you figure that the Fed is going to be buying ETFs on this, that, the other for whatever reason, and you figure that it's going to buy ETF A, ETF B, and then you figure, that's going to hit ETF C, and you anticipate the Fed. That's not fighting the Fed. That's anticipating the Fed. That's buying what the Fed is buying. If you're a newbie investor, this is not relevant to you. I mean, I don't want to sound like a dick, okay? I'm not putting anybody down, but it's just a much more sophisticated trading and investment strategy that a newbie would really need to know. You see what I mean, John?
Yeah.
And yeah, anything else you want to ask me, or anything you want to comment?
No, that's it.
Okay, great talking to you, John. Take it easy. Okay, Mr. Blue. Yeah, my old standby, Mr. Blue. How's it going, my man? Are you there?
Hey, Coach, how's it going?
Pretty good, pretty good. Yourself?
I'm doing all right. Not bad.
Glad to
Just
hear.
collecting a paycheck, working from home.
Yeah. Are you working more hours than before?
Well, so I'm in pharmaceutical sales. So what my company AstraZeneca is having us do is do a lot of virtual engagements with the doctor's offices, and through Viva Engage or through Zoom, where we can actually see them, talk to them.
Yeah.
So yeah, but I mean overall, yeah, no, I'm not working as much.
Okay, that's good to know, because
But I'm still,
a lot of people have been working a lot more now that they're working from home. And a lot of companies are very happy about it. And because from their point of view, it's increasing productivity from the worker. And on top of that, they don't have to pay the office space for the worker. So it's win-win for them. And I think that that's going to be the future for a lot of companies. You know what I mean?
Yeah, and some folks say that trend already started before the coronavirus, and this is just going to accelerate it significantly.
Yeah, I would agree. Yeah. But anyway, so how can I help you? What's on your mind?
All right, so I'm trying to figure out the strength of the dollar. We got the Fed purchasing.
Aren't we all? Okay, I'm sorry to interrupt, man, but go ahead.
Well, yeah, I mean, so that's going to be the name of the game here.
Yeah.
So you got the Fed. They're purchasing corporate bonds, fallen angels, whatever. And now they're just purchased that ETF for the bonds.
Right.
We have stimulus 1. Now Nancy and everybody's talking about stimulus 2.
That one's not going to happen, but yeah, go ahead.
Okay.
It's too big.
Folks,
it's too big.
Yeah. Well, a portion of that's going to happen. Would you say?
Maybe.
Parts of that.
I don't know. It's too big. It's just too fucking big. There are $3 trillion.
Yeah.
Okay. Yeah. No, the only way that they can drive that much cash towards the Treasury bond auction for $3 trillion rather, is if there was a sudden and colossal collapse in the stock market, and everybody got scared shitless and zoomed over to the bond markets, to the Treasury bond markets. It's just too much. Okay. And on top of that, the Democrats, typical, they overplay their hand. They want all kinds of shit that they're not going to get, and they also want like this universal basic income shit, which a lot of people are already realizing it incentivizes people not to fucking work, and nobody wants that. So yeah, I don't think that that's going to happen. But anyway, go ahead. So you're thinking.
Okay. So, and there are a lot of folks that are getting paid, if they made 15, 16, whatever, $20 an hour, they're getting paid more to stay home right now than to go to work.
Yeah.
So where I'm kind of going with this is how are we to, what's a good way to gauge what's going to happen with the dollar? How strong is the dollar? And how do we figure that out if the Fed and the Treasury, if they want to just bail out, create this bridge for the U.S. economy? Well, how do you tell how long they can do it? What's their endurance level? What do you look at to see, how long they can last? Because this market has gone up, ridiculous amount. Yeah, so that's what I'm trying to understand.
I'm trying to understand it too. Okay, everybody's trying to understand it because everybody realizes that the way the game is being played right now, this would end up in some sort of. There are two schools of thought. There's the deflationary school that because all the prices are falling, everything is just going to deflate, right? And then there's the hyperinflationary school that is looking at all these machinations of the Federal Reserve and the Treasury and whatnot, and these stimulus packages and all the rest of this shit. And they're like, this is crazy. This is crazy. What's going to happen? What's going to happen? At this time, it's clear that we're in a deflationary environment. Simple as that. And that no matter what the Fed does at this time, it's going to be deflationary because it's the lack of demand. No matter how much money the Fed prints at this point, it's not going to make up for the lack of demand. And therefore, in a very real sense, the idea of inflation is absurd, and you should just watch as prices deflate. Asset prices deflate, and maybe the stock market and the NASDAQ and the Dow Jones are like levitating, and it's all bullshit. Yeah, fine, but everything else, especially real estate and commodities, they're all going down. Okay, and so maybe the smart thing is to just keep an eye on those markets and make your move there, and in a very real sense, kind of like ignore the financial markets, i.e. the stock and bond markets. Because to tell you the truth, that's what I've been doing. I've been just ignoring them because I had my fill. I made my money. I'm good, and I'm not thinking about that. I'm thinking about real estate because I always think to myself that, see, real estate is forever. Okay, a house, a piece of land, an apartment, a building, an office space, whatever. You're always going to have it, assuming, of course, you don't have exorbitant. Property taxes like you do, like for instance in Illinois, which essentially makes it so that it's not practical to own real estate in Illinois. But if you don't have any kind of like absurd taxes like that, then land is forever and you want to hold on to the land. And therefore my goal at least is to buy land as cheaply as possible, as much as I can with my little wad of cash, and be thinking, 10 years, 20 years ahead, insofar as any kind of investment, like a financial investment of some stock that will be reasonably priced in 5 years. I can't think of a one, not even Apple. I mean, I think that all these things are going to be way lower because, see, there's no demand. And the problem is that the populace has been so shocked, so blown the fuck away by this situation that psychologically they're not going to recover in a year. They're not going to recover in 3 years. I think that I'm going on a tangent here, but hear me out. I think that people don't realize the psychological damage that this has done to the Western democracies, the people of the West, and they're not going to recover anytime soon. This is something that's going to stay with them for years, if not decades, because a lot of them lost businesses. A lot of them lost, 33 million unemployed in the States alone, 33 million unemployed. And how many people depend on those 33 million? At least 2 more. So you're talking that this has a direct effect on 100 million people, and likely more, because the Bureau of Labor Statistics is saying that that number might not be accurate for this, that, the other reason. So, okay, let's leave it at 100 million, man. Half the population, a third of the population of the States has been severely impacted by this thing, because I know very few people who can afford to lose their jobs and they'll be hunky-dory. I know very few people, if any at all, to tell you the truth. And so that kind of trauma, they're not going to go back to buying shit like they used to. No fucking way. And so because our consumer economy was exactly that, a consumer economy, most companies depended on those consumers. They're not going to get those clients back. They're not going to get that revenue back. And so they're going to have to shrink. And that all spells to me deflation everywhere I look, unless somebody really crazy gets into the White House in November, like another Franklin Roosevelt, and starts doing all kinds of crazy ass shit to quote unquote restart the economy, and that causes even more damage. because by the way, I've been reading about the Great Depression because of this thing, and I'm realizing that Franklin Roosevelt, I was sold a pack of lies. He was a bastard, and he created much more damage to the economy after 1932 than people realize. People think that, oh, he saved the economy. Bullshit. He fucked things up royally, you know, and the press covered for him. And so anyway, that's a little high horse. That's for another opportunity. But the point I'm trying to make is that, see, people are not going to go back to their old pace of spending. They'll be too scared and too freaked out and too financially and psychologically damaged. And so the old way is gone forever. And we have to just adapt to the new environment, and we have to sort of like see how it all decants, you know, like in a wine bottle, you know, you pour it out, all the wine into a decanter bottle, right? And the sediment has to settle to the bottom, and it takes a while for that settling to happen. Same thing in this kind of situation. We got to wait around and see what'll happen, you know. But
Okay,
at
so
this
just
time, deflation.
deflation. Okay, and then just finally, what are your thoughts? Trump is talking about negative interest rates. How likely do you think that is, and what do you think would be the ramifications?
I don't pay attention to that kind of crap. Who knows? You know, it's such an it's so how can I put it? See, when they start charging depositors from their money, then I'll believe it. But that day happening in the United States anytime soon, I don't think so. Even though in Europe it does exist. In Europe, if you have 500,000 euros or more, they charge you negative interest. That, i.e., you have to pay money to the bank for them to keep 500,000 euros for you. But of course, the easy trick is to just open a second account and deposit the exceedant. So you have 4,999,000 euros in one account and the rest in the other, and you're golden. So it's kind of stupid, and they'd probably have to do something like that, because it would be absurd to be charging interest rate to somebody. I mean, charging a fee for them to have money in their savings account, and people would use that loophole, and that'd be that. You know, I think it's all bullshit. Okay. As to treasury bonds going negative yield, oh man. I mean, well, anything can happen in this environment. Fucking, you know, oil prices went negative. So who's to say that treasury bonds don't go negative? I don't think that's even possible, quite frankly. I mean, I can't imagine how treasury bonds would actually go negative in yield, rather, not price. Sorry for that. That was a mental blip. I mean, negative in yield. I don't see how that would be possible, quite frankly. But you know, anything is possible at this point. I don't know.
Yeah.
Yeah.
All right. Thank you.
Yeah, but the thing that the message I want to leave is, see, the stock market and the bond market are unreal. That's the message. That's the takeaway at this time. And so that's why I ignore them, because they're not real. They are being manipulated so grotesquely that there's no information that you can get from the NASDAQ or the Dow Jones Industrial Average or any other stock market around the world. They're all being so manipulated that you don't know what's real or not, and therefore just ignore it and try to find signs of something that is real. Okay, so yeah.
Awesome. Thank you.
Take it easy, man. Talk to you next week, I hope.
Yep. Will do.
Great talking to Mr. Blue and to Mr. Delvernois. Patrick, how's it going?
Good, yourself?
Pretty good. What's up?
So I guess all right, so this is my philosophy with everything that's going on right now. And going back to Mr. Blue's question, if he wants to monitor the strength of the dollar, I would heavily look at the gold price, because obviously.
Well, there I disagree. And I see where you're coming from, and I have good reasons why I'm not 100% on gold, but go ahead. And I'll explain my reasoning after you've completed yours.
Oh, no, I was just going to say, like, my philosophy is buying gold and silver would be a good, I guess, play. And so I was wondering, like, currently there's obviously a lack of supply with regards to silver and gold.
Yeah.
So would it be dumb to buy gold and silver now, despite premiums being double or triple than they usually are at this current time?
Okay, well, the thing is, see, you're going to be buying gold certificates, right? They're basically
No, no,
futures.
no, this is physical delivery.
Oh, they're physical delivery.
Yeah,
I don't know.
I ordered gold and or not gold. I ordered 101 ounces of American Silver Eagles in April. And I physically have them. I'm looking at them right now. So,
But isn't that, don't they have such an incredibly high premium because of their alleged numismatic value that it's kind of like pointless to own?
oh no, this isn't just the American Eagles. This is all gold and silver across the board because of a lack of supply.
Hmm. Okay, well, anyway, my thinking on the precious metal market is as follows. See, if they are manipulating the treasury bond market, which is over 100 times bigger than the precious metals market in aggregate, okay? And that's worldwide, by the way, not just the US. Then how easy do you think it would be to manipulate the precious metals market to hide any notion of inflation, hyperinflation? Hmm? So I just don't trust those markets. The markets I do trust are agricultural commodities as a sign of where the dollar is headed. Now, insofar as long-term storage of value, I believe in real estate over precious metals, because the ease of manipulation and the fact that physical delivery of gold and silver nowadays is just so hard. At least in Europe, it's impossible. Okay, and so I'm like, fuck it. I'm just gonna stick with real estate or stick with cash, and I keep my eyes on agricultural commodities, especially for any signs of inflation. And so far, agricultural seem to be fine, and so just look at that and wait. The precious metals market, historically, yeah, sure, the precious metals market has been a store of value, but now there's been so much attention on it. The Federal Reserve is aware of this. The Treasury Department is aware of this. So them putting their thumbs on the scale for their games, whatever games they're playing, is so easy for the precious metals market because it's such a small market. People don't realize how small it is. It's only maybe, what, like something I once heard the number. It was like 30 to 50 billion, something like that. It's not that much.
Yeah, it's something along those lines. So Apple could purchase it with 1% of its funds, like total funds. That's all it is.
I beg your pardon. I didn't quite hear you.
Oh, I noticed. I said, like, to attest how small the metals market is, Apple can purchase it with 1% of its funds, or I think 1% or less, actually.
I don't know. I mean, I think it's more than that because Apple has what, like 150 billion on cash. It doesn't matter.
Maybe
Look,
I'm wrong, but
yeah, but look, the true issue is that I do believe that the worldwide gold market is something like 30 billion. I could be wrong. Somebody correct me if I'm wrong. But the point is, it doesn't even matter. If it were 100 billion or 300 billion, say it's $500 billion just for shits and giggles, right? The treasury market, the treasury bonds market is what? Right now, it must be something like $12 trillion. So, I mean, and the Fed is successfully manipulating that market. So what the fuck you think they could do to the gold market, man? So
hey,
yeah.
prices go down so I can buy more. So
Well, yeah, but the thing is, see, you need delivery, and here's the key issue: you need honest valuation. And I don't think we're going to get any kind of honest valuation from the Fed anytime soon. I mean, that's what they're doing. This is what it is. It's price manipulation. That's what's going on. They're not letting the stock market find its real value. They're not letting the treasury markets, the treasury bond markets find their real value. They're not letting corporate debt markets find their real value. They are manipulating prices to continue the illusion that everything is going well, because they're saying that their rationale is that they're trying to lift up these markets like Atlas lifting up the world, so that eventually, the whole world arrives at the status quo ante as we get over this coronavirus thing, and then things go back to quote unquote normal. But they fail to understand that the coronavirus was not the cause of this disaster. It was the trigger. It was the needle that popped the balloon. The balloon has been being blown up for the last 40 years. And so, yeah, that's my thing. It's a very downer, black-pilled point of view that I have. I'm aware of that, but you know, it's yeah, that's how I see it, man. Sorry.
Oh
Listen,
no,
guys.
the
Oh,
worst is yet.
Patrick, you had a point?
Oh no, I was just saying I agree with you. I think the worst is yet to come. And are you still planning to buy gold and silver after the election, as you said in the last?
I don't know. I don't know. I have to admit it's because I look at the prices and it just all seems unreal, and so I'm like just exhausted because you're trying to second guess people who I realize also something else. These guys don't have a plan. Okay, they're just trying to keep shit. They're playing whack-a-mole. Okay, they don't have a plan. They don't have any kind of strategy. Okay. And I said before that what they're trying to do is keep all the markets up, like the Atlas lifting up the world. Yeah, they're sort of doing that, but they're also doing crazy ass shit on the side. And so who knows what they can do? Okay, there's a complete. They do not trust the free markets. They don't want the free markets to accurately value assets, and so they're doing things that are completely unpredictable. And so because of it, because they are doing things that are unpredictable, because they are constantly changing the rules, there's nothing to be done except just keep your powder dry and just watch that inflation doesn't rear its head. And hopefully it just shrinks in a controlled deflation. That's the best you can hope for. Because if they pass this $3 trillion stimulus package, that would be inflationary because it will incentivize people not to work. And they will have more money by sitting on their ass than by actually working, and therefore inflation would start to rise rapidly because all those people would start to buy stupid shit and people would start to raise prices for all that stupid shit, and we'd get into an out of control cycle, you know. And so yeah, I hope that stimulus package doesn't pass. I don't think it will. I don't think it's politically viable. But if it does, and people get this UBI shit, which is basically free money, then I think that we're going to start to see inflation. But then I could be wrong. So I don't know. I'm just exhausted. So yeah, Patrick, great talking to you, man. Great
You
as
too.
always. Hope to see you next week. And guys, you know, I'm realizing I've gone 3.25 hours. I'm really exhausted. I'm fried, and I'm not making much sense anymore. So I'm going to call it a quits insofar as today's webinar. Thank you so much for attending. I hope you got some good information and good insights, and this helps you to understand this better if you're a newbie. Yeah, and well, that's pretty much it. So I hope to see you soon, and I'll catch you next week. Take it easy, guys.